Standing Committee on Finance. Pursuant to the order of reference from the House, we are meeting on the government's response to the COVID-19 pandemic. Today's place, for your information, is taking place by video conference, and proceedings will be made available via the House of Commons website. With that, I'd certainly like to welcome all our witnesses for coming, number of bank economists and others today, and we really appreciate you appearing. We've had some interesting discussions on the COVID-19 pandemic over the last 5-6 weeks and the challenges that are ahead. So I would ask people if they could to keep their remarks to about 5 minutes. It'll allow more time for questions. So we will start then with Scotiabank, if we could. Jean-Francois Perrault, Chief Economist. Mr. Perrault, the floor is yours. Welcome.
Thank you. You can hear me okay?
Yep.
Good.
All right, Ken.
Good. Thanks very much for organizing this and giving us a chance to speak. I suspect you're going to hear a lot of overlap between what I say and the others, so I'll try and keep it brief in hopes that I won't steal too many people's thunder. But as I think you all know, we are dealing with an economic contraction of historic proportions. There's no other way to characterize it. COVID is leading to essentially as close as we're ever going to get in economic terms to a sudden stop in economic activity. The government, you guys have basically switched the off switch on a range of sectors, and that obviously comes at a significant economic cost. Now, the good thing is, that despite the very significant contraction that we're seeing, the containment efforts, the harm that's been caused seems to have been working in the sense that the virus is beginning to be under control. We've flattened the curve. That is allowing provinces, it's allowing other countries as well to start reopening their economy. So as we think about the year, for instance, it's very important to think about it in two halves. So the first part of the year, a tremendously damaging economic scenario. And the second part of the year, obviously a very significant rebound as we reopen. And we're seeing evidence that reopening is coming with very significant rates of acceleration in certain sectors. We're seeing that in auto sales. We're seeing that on the housing market. In the US, we're seeing that in retail sales activity, which came out. We're seeing that in the labor market. So these are all indications that the economy is on the path to normalizing as we reopen. But it shouldn't be read or interpreted as the economy is going back to where it was. The reality is that when you go from very, very low rates of economic activity to something that's a little bit higher, you're going to get a very strong growth rate, but it still means you're very far away from where you are, right? So as we think about it, for instance, in our forecast, we have a pretty significant decline in growth this year, about -7%. We think it's going to take about a couple of years to go back to where we were at the end of 2019. Right, so the depth of the hole that we are currently in takes a long time to unwind, even with very strong growth rates. And that's under the assumption that the virus remains under control, that it's there's no second wave, there's no reactivation, there's no further shutdowns, there's no kind of additional shock that hits us. This is, in a sense, kind of the best case scenario. Now, one can debate how quickly we rebound, and others have different views on that, but that's generally how we see things. And it's important to keep that in mind because there's this very significant distinction between growth rates and levels, and in this context, that really matters. Right? If you go back to a normal recession, a normal historical economic shock where you'd lose 2 or 3% of economic activity, those used to be big shocks. And now we're talking about a scenario where you lose 7 or 8%. It takes you a long time. This time next year, you're still down 2 or 3% relative to where we used to be. And so it's just this tremendously powerful economic drag. Now, of course, there have been a tremendous amount of policy responses on the federal side and the provincial side. Generally, I think they've been managed reasonably well. They, clearly in an environment where nobody was going to let perfection be the enemy of the good, and I think I kind of congratulate governments for doing that. Now, of course, things could have been done better, but you kind of know that after the fact to some extent. And so the result is, a very significant increase in deficits, an unbelievable increase in deficits, which we think is largely warranted, and we're not particularly worried about because we're starting from a reasonably good fiscal perspective. Doesn't mean to say that that's going to remain the case. If the virus comes back in the fall and then we've got to throw some more money at it, then at some point you start to really worry about fiscal dynamics. But at present, I think the starting point was good. We acted in roughly the right dimension, and we're on a track for a sustained recovery if the virus remains reasonably well contained. Thank you.
Wayne, you want to unmute?
Yeah. Thank you, Francesco. Thank you very much, Mr. Perot. We'll move to the Dominion Lending Centers. Ms. Cooper, Chief Economist, the floor is yours. You're on mute too, Ms. Cooper. There we go.
Okay. Thank you, Mr. Chairman, and thank you, members of the committee, for this opportunity to meet with you this afternoon. None of us has any experience in dealing with a medical emergency that has become an economic crisis. And none of us knows how long this will last or how the end game will play out. I think we all can agree that this is a dilemma like no other, freighted with profound uncertainty. Economic theory and econometric modeling do not provide a specific roadmap. Unlike previous post-war recessions, today's is not an endogenous shock triggered by huge imbalances. Now, to be sure, medical considerations should outweigh economic ones. And the job of policymakers is to mitigate the financial burdens caused by doing the right things on the medical side, which I applaud the authorities for doing. How do we navigate the coming months? In my opinion, this is a question to be answered first by the medical experts to assess the next steps from an economic policy perspective. The government needs to explain its view on the likelihood of a vaccine and antivirals over a 6-month, 1 year, and 3-year time frame. A sober assessment of the outlook for Canadian growth suggests that while the second quarter might be the bottom of the cycle, the economy will only crawl back to full employment. Those hardest hit will be those that can least afford unemployment, exacerbating already unequal income distribution. Small businesses, which account for more than 40% of the private sector jobs, are by now hard hit and in many cases might have already received a death blow. Undeniably, some of these lost jobs are gone for good. The hope is the waves of stimulus doled out by the government and the Bank of Canada will eventually bolster the economy and spark a revival in hiring. The risk, though, is that the pandemic is inflicting a reallocation shock in which some firms and even entire sectors suffer lasting damage. Lost jobs in these sectors don't come back, and unemployment remains elevated. Traditional fiscal stimulus and traditional monetary policy does not address this kind of shock. Now, an estimated 30%, in my view, of the jobs lost from February to May could be the result of this permanent reallocation shock. The labor market will initially recover swiftly, as we saw in the May data. but then level off with still too many people unemployed. Workers in the hospitality industry, accommodation and food are among the most at risk, alongside, I believe, in essential retail, leisure, travel, and education. Most of these people, or many, cannot work from home. In many cases, the pandemic has increased the challenge of bricks and mortar companies facing off against e-commerce platforms such as Amazon, accelerating a pre-crisis trend in which Canadian companies have woefully underperformed. The unique shock of the virus means that governments may need to do more to support businesses and protect workers than they would in a typical recession. This puts the government under pressure to craft policies that help viable cash-strapped firms to survive and displaced workers to navigate to different jobs, but which ideally do not prop up companies that are no longer sustainable. We have already seen evidence that shows that high COVID unemployment benefits can encourage layoffs, discourage work, and delay productive reallocation. We need to know the proportion of Canada's job losses that come from lockdown and weak demand. Those will diminish quickly in response to stimulus and reopening. The part generated by high unemployment benefits encouraging workers to stay home requires a gradual reduction in income support. But the most intractable group of unemployed suffer the permanent fallout from the reallocation shock. For them, the government should provide the training that gets workers ready for the next phase of the technology revolution. The pandemic has accelerated structural shifts that will remain. The efficient response to these shifts requires, among other things, widespread enhanced broadband and computer access for all households, and that's children and adults. Reduced government land use restrictions and occupational licensing restraints, the removal of regulatory barriers to business formation, and interprovincial trade restrictions. These fault lines were there before the virus, but they are now exposed and need a new social contract between government and its citizens. Thank you.
Thank you very much, Ms. Cooper. We'll now go to the Desjardins Group. Matthew Denanjot, Director and Deputy Chief Economist. Mr. Denanjot.
Yes, thank you for inviting me to speak to you today. The COVID-19 pandemic is having indeed dramatic human consequences around the world and raises many major issues for our society. We've already mentioned a few of them. It is first and foremost a health crisis, but the economic consequences are also spectacular. And it is on this aspect that I will try to give you a little bit of perspective today. As a preamble, I think it's important to remember that Desjardins is the leading cooperative financial group in Canada and that it offers a global approach to its 7 million members and clients, including 360,000 businesses. And again, Desjardins' strengths in responding to the challenges of the crisis revolve around democratic governance aligned with the interests of individuals and entrepreneurs. Our integrated cooperative network structure enables us to maintain close relations with our members and clients, especially in Quebec and Ontario, the regions most affected by COVID-19 in Canada. A good part of my job at Desjardins consists in making economic and financial forecasts. This is particularly difficult at this time. when we are experiencing a crisis for which it is very difficult to find a historical precedent. Sometimes we've mentioned a Spanish flu, but that is not a perfect comparison, and that was 100 years ago. So it was quite a long time ago. What we're going through right now looks more like a war or a natural disaster than a classic recession. Prior to the arrival of COVID-19, the economic outlook was quite favorable, and there were no signs of an impending recession in North America. The unemployment rate had even reached an all-time low of 4.5% in Quebec. Last February, 2 months later, it had jumped to 17%. That was unimaginable in a normal time. It's a historic peak. From a purely statistical point of view, the magnitude of the current crisis exceeds anything we have seen since at least the Depression of the 1930s. Between February and April, more than 3 million jobs were lost across the country, and real GDP declined by more than 17%. The magnitude of these declines is about 3 times larger than the very severe recession of the early 1980s, which lasted 6 quarters. An important message is that we must be very cautious when comparing the current crisis to normal recessions. It is completely different. It is an external shock that does not reflect financial imbalances or economic problems that were already present. Described as a desired pause in the economy, which is very different from an uncontrolled route or decline as in the United States in 2008. Moreover, this economic pause is accompanied by unprecedented support from governments to limit the financial consequences for households and businesses. Financial institutions have also done their part by providing significant relief measures to ensure that the economic downturn does not lead to a surge in bankruptcies, and that is not the case, in fact. At Desjardins, we're proud to have been one of the first financial institutions to put in place these measures for our members and clients, and we're determined to continue our support to help them get through the crisis. To date, we have received close to 950,000 requests for our relief measures. Thanks to the various measures offered, the dramatic drop in activity and employment is not currently accompanied by a general increase in financial distress. In fact, in both the United States and Canada, we're seeing a rising household incomes and a dramatic increase in savings, so that's quite different. We must also recognize the essential support of central banks in the current crisis. By mid-March, the situation threatened to turn into a liquidity and financial crisis. However, the Federal Reserve and the Bank of Canada acted decisively to ensure the proper functioning of financial markets by injecting massive amounts of liquidity and even by directly purchasing riskier assets. Today, markets are functioning well and liquidity is plentiful. This allows financial institutions to continue to play their role, including by providing affordable credit to households and businesses. So, in my opinion, it is far too early to say that we're experiencing the worst economic crisis in recent decades and that a depression is inevitable. The drop in GDP will be spectacular this year because of the pause months. But if we succeed in deconfining, ending lockdown over the next few months, the consequences for households and businesses could be fairly limited. It doesn't mean there won't be one. Our forecasts are thus expecting a strong rebound in activity in the coming months, but the effects on some sectors will last longer. We anticipate that it will take until 2022 for real GDP to return to pre-crisis levels, and that is a long time away. In the short term, a drop in unemployment rates is almost certain if deconfinement, that is, ending lockdown, continues, as we're already seeing in Quebec. There was a strong drop in May, but the question is rather of whether the Canadian unemployment rate will return to 10%, 8%, or 6% in a few months, and also what trend the economy will take after that. I think this will depend on the evolution of the pandemic and the measures, the social distancing measures, as well as the recovery in household and business confidence. Thank you very much for listening, and I'm available to answer your questions.
Thank you very much, Mr. Danjal. Turning then to CIBC Capital Markets, Avery Shenfield, Manager Director and Chief Economist. Mr. Shenfield?
Thanks very much. So I don't think our outlook is materially different than the one we heard right off the top from my friend JP at Scotia. In fact, I'm often told, there's a lot of uncertainty out there. And actually, this is one of the times in my career which I would say that there's less uncertainty out there than I've seen in my career. And that's because unless you're very picky about the exact numbers, we know what the economy is roughly going to look like over the next year, which is we're starting from a position now, which is horrible. best described. We've seen a decline in GDP leading up to April that you really have to go back to the Great Depression to see something similar. And I like to say that, I'm getting sick of living in this sort of environment. I think we all want to live in what I call precedented times again, but we're not there, and we have a long way to go. And the reason I say that it's fairly certain the way the outlook is going to look is that if we run out over the next year, and barring a record-breaking vaccine and a deployment among billions of people, we know that at least over the next year, there are segments of the economy that health restrictions, which are going to remain in place, are going to keep essentially shut down. So the people who used to work at nightclubs and wedding halls and crowded convention centers and so on will simply be shut out of this economic recovery. And then there are other sectors we know tied to international tourism, even restaurants that are going to have to open at less than full capacity. We can pretty much with confidence predict that these sectors will not be back where they were at the start. And if we add up the share of GDP that is in those industries or the share of employment that's in those industries, you're looking at still a pretty substantial gap to where full employment is, even a year out. And that's even assuming that we take every step along the way at exactly the right timing in terms of managing to avoid a big second outbreak that causes us to have to do a hasty retreat. So, when we define it in terms of unemployment rates, for example, if everything goes well, we might be sitting with an 8.5% unemployment rate a year from now. But remember, full employment is more like 5.5%, and 8.5% is about where we were in the last recession. So we're going to recover from a depression level of activity to a recession level of activity, not particularly good. Beyond next year, it's going to take some time for the economy to recover, even if a vaccine is in place at the end of 2021. So we're looking at an extended period with very little uncertainty that the economy is not going to be good. And that spells out what kind of policy environment I think we're in. So let me turn to what I think the role of government in this. I think the initial role of government was exactly what Parliament in its wisdom decided to do, which is band together and make sure that we protected the most vulnerable people right away, tried to prevent a wave of defaults and bankruptcies among Canadian businesses that would then disappear and not be able to restart when times return, and also protect, of course, households, enable them to put food on the table, pay their rent, and so on. That was the immediate crisis, and Parliament worked at actually record speed to get that done, in many cases faster than the US managed to accomplish the same task. So some kudos to the government and the civil servants in particular who work hard on getting these programs out the door. When we look ahead, the number one priority for government is actually on the health side. It's making sure that, in fact, sound decisions are taken about what to open, what to reopen, and how to do so safely, because we know that the worst possible outcome is a second wave, as we've seen with some prior pandemics, that can't be snuffed out quickly and leads us to have to go back to where we were in April. And that's why I think governments have to look at things like making masks mandatory indoors, listening very carefully to what the health authorities are recommending, and doing the right thing. There is no trade-off, and I want to emphasize this, between the economy and health. If we think that by letting businesses open that are marginally safe, that we're doing them a favor, we're not, because if the virus comes back and people get sick, not only will we take a big step backward on the economy, and I do fear this in some US states, more than in Canada, but we'll take a big step backwards, but we will also tarnish household confidence. And if we look at countries, for example, like China, that are a few months ahead of Canada in getting the virus down to low levels, they have not seen a full recovery in consumer spending because people have remained cautious and afraid. We have to make sure that people have an assurance that governments are taking and businesses are taking all the right steps. And in some cases, businesses need the guiding hand of government to guide them to that. So that's the single most important criteria for policy. The second obligation is to really make sure that we don't pull the rug out from under the economy while it's still very weak. So we recently had the decision to extend the CERB program another couple of months. There's also been an extension of the wage subsidy program. And much as some people don't like the idea of big deficits, they're really not that costly when you're borrowing at a 0.5% rate of interest. A $300 billion deficit costs the government an extra $1.5 billion in interest payments. It's not really a huge share of government revenue down the road. And it's a necessity, really, to make sure that the fiscal stimulus stays in place while we're still wrestling with double-digit unemployment rates in the economy. The last thing we need is a collapse of the household sector and the business sector so it can't reopen when the time is right. If I think about how these various policies have to shift over time, though, we do need, as we get more jobs coming back, to look at building in some nuances in some of these programs to make sure that we're not providing disincentives for people to work where there are jobs available. And it's important to distinguish that. So, for example, in the EI program, we have different weeks of eligibility depending on your region and what the background level of unemployment is. Those are steps designed in that program to ensure that we don't create inappropriate disincentives. That wasn't important when these policies were first announced because we had millions of people losing their jobs. There was no job available. Will become more important really over the next year or so as the economy opens up. When I think of the work that's been done to let businesses tide themselves through this period of almost hibernation for the economy, many of these programs have worked quite well. I think there's still some work to do, though, in taking a look at small businesses within cities, particularly the retail sector and so on. We don't want to end up with our main streets across Canada, for example, with just a forest of vacant outlets a year from now. We need some of these businesses to hang in there, and I think we have to look at making sure that we've benchmarked the support correctly across that sector so that they can hang in there through this period. We won't save them all, but we don't want to have our cities look like downtown Detroit. We want them to look like downtown Vancouver and Toronto did before this started, or Montreal for that matter. I think that's very important. I think municipal governments are going to be very constrained. They, unlike provinces and the federal government, can't just simply run a deficit. They have to balance the books to some extent. They have reserve funds they can draw on, but they've lost a lot of revenue. A lot of that came from land transfer taxes, subway fares in some of the major cities and so on, all dried up. So I think making sure that the municipal sector doesn't have to start a major fiscal restraint program while the recession is still in place or recession conditions are still in place is another thing that the government has to look at. But overall, I would say that the outlook that's been presented to you today by the various economists is a realistic one, that we're probably through the worst, but saying the best is yet to come, and the spectacular growth rates we're likely to see off these very low levels of activity shouldn't deter you from the focus on the fact that even if we make tremendous progress, we may still have an 8.5% unemployment rate a year from now. GDP will be well below where it would have been had we grown at 1.5% or 2% a year. And so the job of government to sort of fill in the cracks, keep the economy in a state where it can reawaken when the time comes. I think that job is still very much with you. And I'm encouraged by what I've seen so far, and a government's willing to work across party lines to get things done, and hope we continue to see that. And I'll be happy to take your questions.
Thank you very much, Avery. Going now to Catch Capital Partners Incorporated, Mr. Wareham, CEO. Mr. Wareham, floor is yours.
Thank you, Chairman Easter. First of all, I would like to take a moment before making my comments just to express some gratitude that I think a lot of Canadians share. My friend and mentor and a former colleague of many of you is a gentleman by the name of the Honorable Ed Holder. And he once told me that there's no higher calling or commitment than the commitment to public service. And quite frankly, I think that our political class has been put through a fair bit over the last few months, and I'd like to thank everyone for their service. I spent 30 years, as of today, actually, in the financial services business, starting in insurance and then banking, and then moved to vice presidency of an investment dealer. And ultimately, I've ended up as a director of a Canadian mutual fund company. So I've had somewhat diverse experience around the financial services sector. And in my semi-retirement, I've also had the unique opportunity of sitting on the boards of not only a couple of Canadian companies, but also a couple of U.S. companies. And I'd certainly welcome questions at the end of the presentations on the difference in the experience as a director between Canada and the U.S. and how some of the different programs have been implemented. Our nation is embarking, hopefully, on the recovery phase of the crisis. I believe it's critical to take a look at two really important cornerstones of our economy historically. The first of those is obviously our strong, stable, globally recognized banking system. And the second is the entrepreneurial community that's been a part of Canada's history right back from our establishment. Both of these are things for which Canada is recognized. Quite honestly, although we're recognized for both, I'm not sure that that these things always move well in parallel. And in the best of times, commercial credit can be difficult for small businesses, small and medium-sized entities, and these are certainly not the best of times. So, as I said, these two realities really are, in fairness, not always closely related. The success that we have with entrepreneurship and business development, and the success of our banking sector. The Canadian banks, as I said, are recognized globally for their strength and for their sound banking practices. And much of the Western world in the 2008-2009 credit crisis really had disasters on their hand, and between some very strong leadership at the federal government level and some strong leadership at the banking level, we're able to navigate that crisis, I'd say, better than just about any other nation in the Western world. That said, there were still some bumps and bruises. Right now, Canadian banks are faced with an unbelievable combination. We've had, coming out of that credit crisis, a lengthy period of real estate appreciation, followed with, and tagging along with that has been a massive expansion of consumer debt. And now we're looking at a total decimation of the commercial real estate sector, massive job losses, and the potential of a mortgage cliff a few months out that will certainly impact the banking sector. So, as we sit on this committee discussion today, I certainly don't believe that the solution is going to be coming out of this, that our strong banking system is going to be able to extend credit or more generosity to small business. And I believe that that's a real challenge. Our banks are going to have to do everything in their power to ensure that their balance sheets are strong and that their income statements are not impacted too dramatically as well by near zero interest rates, which I think are with us for a long time to come. That being said, I think that it's important that the committee and that the government of Canada take a look at how it might intervene in the economy, recognizing that, as I believe, that it'll be very difficult to do that through traditional banking models. With us having, essentially half a dozen big dominant banks in Canada, it's perhaps more difficult in Canada to reach through to the small business than it is in some other countries where we have more, I would say, where many other Western nations have more developed alternative finance businesses. Our tightly, our tight number of banks and our small collection of large banks, does present one challenge that really has emerged over the last number of years and really was exacerbated in the last crisis, in the credit crisis. And that's that, 20, 30 years ago, an awful lot of investment product for entrepreneurs that lacked access to traditional bank lending, they could go to the capital markets and borrow money either through IPOs of small businesses, high yield debt. They could go to leasing companies. There was asset-backed commercial paper. There were a lot of different alternatives for financing, and a lot of these have disappeared. And this is not a point of blame. It's just a reality. In the capital markets world, the syndication desks that look after the issuance of new products to investment clients, have essentially contracted as the banks have, gobbled up probably 90% of the wealth management assets in Canada, and relatively few, shall we say, innovative investment or financing products are making it out to retail investors. A lot of good reasons for this. They certainly present higher risk. The desire to protect investors from scams, from inappropriate vehicles, from things that don't suit their comfort level with risk. And some of the products that we discovered really weren't as safe as they appeared to be going into the credit crisis in 2008. There's valid reasons that these sources of funding may have dried up. But I think that as we enter the recovery phase, it's important to talk about how we can reach out to our capital markets businesses and find alternative solutions that that don't put pressure on, for example, the banks to reach out and step outside of their traditional lending mandates that they do very well, but allow our small businesses to access more secure sources of factoring, of trade credit, of leasing. All of these sources ultimately trickle back up to the banks, and or to bank alternatives like insurance companies. And in many cases, those sources are just not going to be available with the pressure that's being put onto our major financial institutions. The government does have an opportunity to work, whether it's with moral suasion or with policy, and particularly with direct support to programs, to work with innovative entrepreneurs that have capital markets experience, but that may not be a part of the traditional bank model, that can come forward with lending and financing solutions. I've spearheaded a group that has put forward a proposal that has made it to several members of the committee, that's based essentially on the principle of the victory bond back in the Second World War. And that really is the last, and I've read a couple of the commentary of different economists on this call that have pointed out that, that really we're going through an economic crisis that really hasn't seen a precedent since World War II. So it's good to look back at what worked through history. On that note, I certainly would welcome any comments or questions people have on what I see as far as the junior capital markets and the opportunities there to work in conjunction with the banks, in conjunction with their syndication departments, and in conjunction with the federal government to make sure that trade credit and financing, factoring is available to the small and medium enterprises that are going to be so critical in ensuring that we aren't at 8 or 10% unemployment 2 or 3 years out.
Thank you very much, Mr. Wareham. We'll go next to the Canadian Centre for Policy Alternatives. David McDonald, Senior Economist. Welcome back, David. You've been here before. The floor is yours.
Thanks so much for that, Mr. Chair, and thanks so much for the committee for their invitation to speak today. First of all, I would like to congratulate the federal government on its reaction to this crisis, and in particular on the creation of the emergency benefit. It was certainly a highlight of government action in this pandemic, as I've remarked before this committee. And while the 2-month extension to the CERB is welcome, I would encourage the government to start planning now towards a new modern EI system with a transition strategy to that end. Some of the features of a new EI system should be borrowed from the success of CERB, including its speed, a minimum payment, say $500 a week, and in particular, better coverage for gig and self-employed workers. However, I would like to focus my comments today on the government's interventions into the financial sector, with programs, which programs have been taken up, which ones haven't, and how we could improve those interventions. I think it's worth taking stock of the approximately $750 billion promised in support for the financial sector. By my count, $679 billion of this amount has been deployed. The reduction in the bank's domestic stability buffer has provided them with an additional $300 billion if they choose to use it. The Bank of Canada was initially scheduled to spend $300 billion, although its balance sheet has now expanded to $373 billion as of last Wednesday. Almost half of that expansion is due to the increase in its repurchase agreements. On the other hand, the mortgage purchase program through CMHC has managed to buy almost no mortgages, spending only $6 billion of its $150 billion budget, with the last 2 purchases buying essentially nothing, and the next one scheduled for June 22nd next week. The lowering in particular the domestic stability buffer from 2.25% to 1% of risk-weighted assets would free up as much as $300 billion in assets for other purchases for financial actors. OSFI would prefer if those purposes were to provide further loans to businesses or households. However, this assumes that banks can find households or businesses who are both creditworthy and are willing to take on another $300 billion in debt in the middle of the worst labor market since 1936. That $300 billion could be used for other purposes, much less desirable than lending. As within any large corporation, money is fungible and its purposes can change. For instance, it could be used to pay out shareholders, executives, or it could be used to cover loan losses. Thankfully, OSFI has explicitly barred banks from continuing with any existing share buyback programs. However, dividend payments and executive bonuses can be maintained but not increased. In the first quarter of 2020, the banks paid out $5 billion in dividends, and they are on track to pay out $22 billion to shareholders over the course of 2020. In other words, 7% of the gain from the change in the stability buffer could still be paid out to shareholders despite OSFI rules as they stand today. While senior financial executives will not be able to increase their total pay above what they stood in the previous years, given ever-increasing executive pay in Canada, this is hardly a stringent restriction. In 2018, the top executives at Canadian banks raked in $173 million in bonuses alone across 31 people. If this is the pay bar that they have to fit under, given extraordinary government supports for the sector, it likely won't cause them any difficulty. I would recommend that this committee examine international approaches like those in the EU or the UK that suspended bank dividends and executive bonuses for the period of extraordinary government supports. A Bank of Canada study released earlier this month found that the deferral of mortgage payments is an important way to keep Canadians who've temporarily lost work in their homes and reduce the likelihood of a downward spiral of net worth through a rushed home sale. With 14% of all mortgages now in a deferral position, this has been a lifeline to the 4.8 million Canadians who've lost their jobs or the majority of their hours since February. OSFI is allowing the banks not to have to increase their capital requirements due to non-performing loans, makes this crisis of mortgage repayments much cheaper for the banks if they engage in a deferral process. With between 12 to 18% of mortgages presently in deferral, depending on the bank, increased capital requirements would have otherwise led to material impact on the bank's bottom lines. I'd encourage the committee to request the banks not charge interest and other penalties over the deferral period of mortgages, but not only on mortgages, also on higher interest products like credit cards and lines of credit. Given the slow recovery so far, I'd recommend the committee also considering extending the loan deferral period from September until the end of 2020. Furthermore, many Canadians simply won't get their jobs back, even by the end of the year, and many will conclude that it isn't financially viable to stay in their present homes. The mortgage costs will just be too high, given job losses. Mortgages, particularly fixed rate ones, carry substantial penalties for early repayment. The committee should consider reducing or eliminating these prepayment penalties, allowing Canadians more easily to sell houses they can no longer afford and get into new houses they can afford without paying extraordinary penalties in the process. Thank you, and I look forward to your questions.
Thank you very much, Mr. McDonald. And before I turn to Mr. Porter, I'll give members the lineup for the first round of questions. First up will be Mr. Polyev, followed by Mr. Fraser, then Mr. St. Marie, and Mr. Julian. Mr. Porter, Bank of Montreal, welcome. You had some technical problems like we folks in the country often have. Welcome.
Thank you. Well, all's well that ends well. And good afternoon, Chair and committee members. Thank you for the invitation and the opportunity to speak with you today. I'll keep my remarks relatively brief because I largely agree with those who spoke on the economic outlook earlier. In brief, Canada has just experienced the deepest and sharpest economic downturn in the post-war era, but it also now looks to have been the shortest recession ever, as well as there are plenty of signs that activity, jobs, and spending began to recover in May alongside the initial stages of the reopening in many parts of the country and through the rest of the world. But while some of the latest economic indicators are no doubt encouraging, there's also little doubt that we're climbing out of a deep valley. Preliminary evidence from Statistics Canada, as earlier mentioned, suggests that the economy fell by 17% in March and April alone, and that may well be revised even higher to a deeper decline. And again, to put that in context, the previously largest decline was in the early 1980s recession when output fell by just a little bit more than 5% over 1.5 years. As economies reopen, we think a large share of this drop can be reversed and relatively quickly. However, it's also apparent that in the absence of an effective vaccine, certain sectors will remain heavily constrained for an extended period of time, likely constraining the overall economy. And crucially, most of these sectors that will remain constrained do tend to have above average employment levels. So if anything, the employment effect of the constrained sectors will be even more than what the overall GDP numbers suggest. So even though we currently project a % rebound in activity next year after we believe a similar decline this year, that would still leave the economy 3 to 4% below where it normally would have been by the end of next year, and the unemployment rate is likely to be 2 to 3 percentage points higher than pre-crisis levels, even by the end of 2021. Moreover, the economy does face an important challenge transitioning from the initial reopening phase to the recovery phase. So even as the need for the most extreme policy measures do fade, the economy will require, as mentioned earlier, support for a longer period of time. And policy will need to strike the appropriate balance between supporting incomes and not discouraging work incentives. And while we recognize it is still a highly uncertain environment, the upcoming fiscal snapshot is welcome, as it will help to give us all a firm foundation for future decisions. Looking further out over the medium term, we are relatively upbeat on the prospects for the recovery. Individuals and businesses are incredibly resourceful, as we have seen in recent months, and they can learn to deal with challenging circumstances. So we don't think we should discount the ability of the economy to recover. With that, I'll turn it back to you, Mr. Chair. Thank you.
Thank you. Thank you very much to you, Mr. Porter, and to all the witnesses for their presentations. The first round will be a 6-minute round, and we'll start with Mr. Polyev. Pierre, the floor is yours. Your mic's on, Pierre.
Thank you very much for your testimony, everyone. Whichever bank economists wish to answer this question can jump in. I'm just looking for the number here, not for any commentary. But what share of your bank's assets are backed up by the government? By backed up, I mean have guarantees by the government, directly or indirectly, in the form of CMHC or 90% backups of Canada Guarantee and Genworth and other forms of guarantees. What percentage? If you don't have an answer to that question, feel free just not to chime in on this question.
Okay, who wants to take it? No volunteers? Go ahead, Mr. Zandveld.
So I think the silence is that we don't run these banks, so we don't always know everything about banking. They don't let me run the bank, at least. But what I would say is that share has come down substantially. So, the CMHC, for example, not only used to guarantee mortgages for people who didn't have the 20% down payment, but also had a program where basically the bank could buy the CMHC insurance in bulk on mortgages that the buyer didn't require the insurance, and banks were doing that and then using that to so the portfolio. So that's fallen a lot. Whatever that number is, it's down substantially, but I don't know the number, and I suspect.
Okay, I don't see any other volunteers, but it'd be. But I don't want any commentary on that. I just need numbers. Do you have numbers, Dave, with Mr. McDonald?
Raw numbers, yes, sir.
Okay, fire away.
The maximum insurance in force allowed through CMHC is just over $700 billion on residential mortgages. The total residential mortgage value in Canada is roughly $1.2 trillion. And so this isn't a bank-by-bank breakdown, but what is 7 divided by 12 is your ratio.
That's
so about 60%-ish.
That's just mortgages, though.
That's just mortgages, right?
Mortgages, yeah. So banks have lots of other assets like loans.
Of course. But it just, I guess sometimes I wonder why banks have so little concern about the indebtedness of Canadian households. Not all of them, but some have not expressed the kind of alarm that I see when I look at the numbers. And it seems to me that's partly because banks are protected against any future serious meltdown and defaults because their largest consumer lending book is to homeowners whose mortgages are backed up by the government, and therefore the risk is really with taxpayers rather than bankers. And so I'm very worried about the degree of debt we have in this country. Before the crisis, we were at 356% of GDP, public and private combined, which is the second highest in the G7, only after Japan, and that was all before COVID-19. Do any of the witnesses want to comment on the serious possibility of some sort of debt crisis or crunch that could befall our public or private sectors as a result of those high levels of debt and the eventual and inevitable increase in interest rates in the medium term?
Okay, who wants to go for that one? Ms. Cooper, go ahead.
Okay, I'll take a stab at this. I think it's important to understand exactly, drill down into the mortgage debt and credit card debt parts of household debt. Or let's call it collateralized debt versus credit card debt. In terms of collateralized debt, it's really quite interesting that 40% of Canadian homeowners don't even have a mortgage. And the Bank of Canada estimates that it's roughly 12% of Canadian homeowners that have mortgages that are at what the bank considers excessive levels. The fact is that 58% of Canadian households have virtually no debt at all. In other words, debt of less than $25,000. And a lot of the time, the policymakers seem to be most concerned about housing debt as opposed to credit card debt, which is certainly not my point of view, and not just because I work for a mortgage lender, but because from a personal perspective, I've never paid just the minimum on a credit card, and I've taught my son not to do that either because interest rates are so high.
Ms. Cooper, I think if everyone was as good with money as you are, then our nation would be in spectacular financial shape. But I'm concerned about the people who are not within the 40% of mortgage-free Canadians. And I'm concerned about the others who are mortgaged. And the fact that there is such a large group of people who have limited debt means that in order for us to arrive at the total household debt ratio of 177%, then there must be another group of people that are extraordinarily indebted.
Yes.
And who are these people who are bringing up the national household indebtedness average? And how vulnerable are they to a major credit event? Ms. Cooper and or anybody else who wants to testify.
So who wants to go with that? Mr. McDonald, you're on.
Thank you very much for the question. I do want to revise my earlier statement. I have in fact looked it up at the end of the first quarter of 2020. 30% of all mortgages in Canada were insured by the federal government, by CMHC. In any event, to your point, Mr. Poilievre, the higher debt is primarily being held among younger households who did not get it into the housing market early enough and therefore did not have substantial amounts of equity that a lot of Canadians have seen being run up since about 2002. And they're also more commonly in big cities where housing prices are very high. And so certainly high household debt as well as high corporate debt, I mean, corporate debt has risen quite substantially in the last 5 years, means that lower interest rates that would otherwise encourage households and businesses to take out more loans are much less effective. And so despite the fact that we're at zero interest rates, it's not very useful. We're not seeing tremendous economic growth as a result.
Any chance I can squeeze in one last
You're already a minute over, but I'll be kind today because I know you very much want another question.
Okay, thank you very much, Chairman. My question first to Mr. McDonald and then anyone else who wants to jump in. In the post-2008 financial crisis in the United States, massive quantitative easing effectively inflated asset values and represented a major wealth transfer to people who owned assets, while effectively reducing the value of the wages that working class and impoverished Americans earned. Now we have this same quantitative easing in Canada, almost 400 billion of it. Mr. McDonald, you believe that the creation of all this money is just going to, and again, inflate the assets of the very wealthy and reduce the real value of the wages of the working class? And anyone else can jump in if they want as well.
Okay, Mr. McDonald, and I'll look for a hand if there's anybody else, and we'll let him move on. Mr. McDonald, okay, and then Mr. Schenfeld.
Thanks so much for the question. Certainly, the Bank of Canada has actually always been engaged in buying some portion of federal government debt. That's ranged from about 5% in the 1980s to about 15% recently. It was as high as 25% in the 1970s, and given the recent purchases of the federal government of the Bank of Canada federal government debt, it will likely rise to in the neighborhood of 27%. It is certainly higher, than we've seen historically, but not out of all range. The main concern of the Bank of Canada purchasing that much federal government debt is the creation of inflation, which is a particular concern if economies are at full capacity, with 25% of our labor force being unemployed since February or losing the majority of their hours. That's hardly a concern, as well as 2 months of negative inflation, not positive inflation. I don't think that's a terrible concern, but
okay, Mr. Schenfeld, fairly tight, if you could.
Yeah, I would just echo that. Many countries experimented with similar quantitative easing programs after the 2008 recession. Canada had a milder recession, so we didn't have to do that. None of those countries were left with a legacy of inflation. So while the premise of the question is right, that asset values are protected, and we're trying to do that, in fact, to retain some business confidence, but also to suppress interest rates. And remember, the government is borrowing hundreds of billions of dollars to finance this rescue effort. I think it's quite good that they're borrowing at a 0.5% interest rate as opposed to 2%. And to the extent that, for now, no, but I mean, this is giving the government the opportunity to lock in some fairly good low rates. And again, none of the countries that did QE ended up with soaring interest rates afterwards, nor did they end up with soaring inflation. So by and large, I'd say that the Bank of Canada has shown a lot of wisdom in using this extraordinary tool to deal with an extraordinary recession.
Okay, we'll let him move on to Mr. Fraser, and I'm sorry, Mr. Fraser, you won't get quite as much time. Go ahead, John.
My God, you can never get a fair shake here. Thanks, Mr. Chair. I got lots of questions. I'll try to keep them tight, and I'd ask that the witnesses do the same in the response. I'll go first to Mr. Schenfeld. There was a certain level of optimism, frankly, that I've heard that within a few years, we're probably going to get back to 2019 levels of economic production in Canada. One of the things that I'm concerned about is not being satisfied that we get there in a few years, but what happens to those people who are living on the bubble in the intervening period? I'm curious if you have advice for us on what we can do during the transition and recovery, not only to get our GDP back to where it might have been in 2019 or unemployment levels, but where we can also ensure that we mitigate against the possibility of widespread bankruptcies at the household or small business level.
So I think, first of all, getting back to the level of GDP doesn't get you back to the same unemployment rate, because population grows. You actually have to be well above the previous level of GDP. So we're going to be in this soup for a while. And I think your premise of your question is absolutely right. Government programs are going to have to play a role in protecting against insolvencies. Yes, I'm a banker, but actually I care about people going bust, because they also have our credit cards, not just mortgages that are insured. But as a Canadian, I also want to see our economy get through this slumber period. And that means partly ensuring that households have some spending power when this is all done. So I think the right approach is certainly to look at all the various things that we're now doing for businesses and for households. And we're going to manage them down to some extent as unemployment falls. I mean, the cost of these programs will come down. As job opportunities open up, we're going to have to provide appropriate incentives. So, for example, the CERB program has one not so great feature that if I earn $1,000, I get a $2,000 check. But if I earn $1,001, I get nothing. So someone who's earning $1,000 a month has no incentive to look for a job that's going to pay him another $500. And similarly, the program that was designed for the wage subsidy had a particular cutoff. So we're going to need to re-examine these. And unfortunately, we now have some time to do that and to design the programs in a way that provides some incentives. But nevertheless, the support programs in some form have to stay in place, because otherwise we do get a wave of bankruptcies. I mean, we're going to see some of that anyway. We can't rescue all businesses. I think Sherry suggested that. I think she's right. There are going to be things that unfortunately go under, and households that are going to struggle, and banks have taken some pretty big hits in their recent quarter earnings to provide for the losses associated with that. But I think government still has to play a big role here. It's a long wait for the economy to be good again.
Thank you. That's a good segue into my next question, which I'll direct to Mr. Perot. Mr. Schenfeld made the point on one occasion during his remarks that it's not particularly costly right now to borrow to cover some of the cost of these programs that were really created by the pandemic. We've made the decision that the federal government is better positioned than households and businesses to bear those costs. Mr. Perot, you made the point that there may come a time when that may not be the case. I'm curious if the pandemic is the source point of these increased costs. Is there a tipping point? What indicators should we be looking for when we should say the federal government is no longer the organization that should be bearing this cost, but perhaps it should go to a different level of government or to households or businesses? Because I have a hard time seeing where they will be better positioned to incur these costs than will be the federal government.
I mean, it's a great question. Like, the fundamental challenge that I think the country is dealing with now is, sure, there is lots of debt in the country. There's no question. When you layer it all together, as Mr. Poilievre indicated, we are a highly indebted country. But we are in this very difficult economic circumstance that requires a tremendous amount of support to get us through to the other side. And the question very much is, who's got the best balance sheet to do that? And it's clearly not households. It's clearly not provincial governments. It's clearly not municipal governments. They can't even do anything. It's going to fall on the federal government. So even in a worst case scenario, and with the resurgence of the virus and requiring, an extension of the CERB or sustained wage subsidies or massive amounts of money going into training programs, if that were to be required at some point in time, we're still in a world where, the federal government is going to be the entity with the best balance sheet to help us manage that. Now, at some points, markets may not agree with that, but that's the reality as far as I can see it at present.
Thank you for that feedback, Mr. Chair. Have I got time for one quick one?
Yep.
Excellent. This is to Ms. Cooper. I was fascinated by your testimony. There was a number of pieces that jumped out, so thank you for being here. One of the points that you made was that the federal government should be looking to support viable businesses that will essentially be able to stand on their own 2 feet in the back end of this pandemic. We don't want to throw good money after bad, and I completely agree. However, there is a part of me that wonders, is the federal government really the body to pick winners and losers? Because quite frankly, the private sector can surprise people. There is an entrepreneurial spirit when people have their own skin in the game that oftentimes is more effective than policymakers sitting in a boardroom in Ottawa. And I'm curious, how can we conduct an exercise that will give us confidence that the support that we're putting out there into the marketplace is actually reaching viable businesses and not just delaying the inevitable for businesses that weren't structurally sound going into this pandemic?
Exactly. And that's the great conundrum. And I don't believe that it should be politicians or bureaucrats in Ottawa that should be making those decisions. I think businesses themselves, in even the hardest hit sectors, some will be big winners because they're making adjustments. And there's so many examples of them where the businesses that have learned to do business remotely or to provide literally safe services and goods in a very user-friendly way, are going to outperform. And that's going to be different for every sector of the economy. And so you can't have blanket money giveaways. And I do believe that there ought to be private-public coordination in terms of just how these assessments should be made. As an economist, I have to say we need to let the markets work. And that means that if you aren't creditworthy, you shouldn't be able to borrow money. Now, if you aren't creditworthy for a moment in time, for a short period when you're cash strapped for very good reasons, you've been forced not to open your doors and your fixed costs are being paid, that's one thing. But unfortunately, what this pandemic has done is showed us who the weak players were to begin with. And many of those people will not reopen their doors, nor should we subsidize them to make them do so, because it's an inefficient allocation of resources and very unfair to the taxpayer.
Okay.
Thank you, Mr. Chair, and thank you to our panelists. This has been terrific. I wish I had another hour of questions, but I'll cut her off there.
Thank you, Sean. Mr. St. Marie next, followed by Mr. Julian. Gabriel?
Oui, merci. Wayne?
Thank you, Wayne. Gentlemen and ma'am, thank you very much for your presentations and your presence this afternoon. They've been extremely interesting. My questions are for Mr. Danjou. So thank you for your attendance and thank you for your presentation as well. It's quite worrisome to hear you say that this current crisis has few historic financial crises. It can't compare. In fact, it brings us back to wartime. Now, on a much more down-to-earth topic, my first question for you is this. So how do you go about negotiating with the government? That is, the government puts in a request, it puts in a request for assistance for the pandemic and with partners, and there are a number of partners involved in the emergency account. So exactly how do you go about doing the negotiation? It's a good question. I'm not aware of all of the negotiations, but thank you for the question. But right now, we are quite comfortable in our relationship. We have a number of different programs underway, more specifically with companies. We're very comfortable with this. We've taken on more or less the same approach as to the relief measures. We needed to act quickly to provide support to those who were greatly impacted by this economic pause. I can't really speak to how the negotiations are going, but we are quite comfortable in playing this partnership role with government to support our clients. Thank you. As well, I was absolutely amazed by the statistic that you pulled out, the one that you referred to. You said, and if I understood you correctly, it's 950,000 requests for relief among your members. Is that correct? Yes, this includes everything. You might have one member putting in several applications. It could be for mortgages. It can be about credit cards. We have quite a number of different programs available, as well as for companies where we have an emergency loan available, as well for households. We have different relief programs, and we believe that it's important to support people, not only to provide relief efforts. And I think it's very important that we undertake this transition right now. We have a lot of people who receive revenue support to pay for their mortgages. They're able to overcome this. But what we need to do is to avoid arriving at a point where everything happens at the same time. No money is coming in anymore because the relief programs are over. You cannot pay your mortgage, etc. I think we need to move towards the transition. We have to ensure that people are able to get back to work, to find a job so that they're able to cover mortgage payments, etc. But we realize that this isn't going to happen overnight and that we'll need to continue supporting our clients. Thank you very much. In fact, this transition period will be vital, and it will be important to have a proper modeling of the definition of these transition measures we need. CERB has been referred to, and that's not based on the income we made, such as $1,000. When you make $1,000 and when you lose everything, we understand that during the first weeks the government was unable to factor all of this into it, but it's been 3 months now. I think we need to incite people to go back to work. But before I come to questions about these specific measures, you also said in your presentation that because of the pandemic, we're putting the economy on pause deliberately and we'll come back and it should run well after this. Except that one of my concerns is as follows. Of course, there will be some sectors of the economy that will not be able to rebound to the point that they were at previously. Habits will have changed. The post-crisis will not be identical to the pre-crisis time. This was mentioned by your colleague as well. But regarding those sectors that will have some difficulty, for example, neighborhood businesses, let's say people start getting used to buying online more and more. What do we do about, for example, local jobs? These are important jobs and important companies and important services as well. So as far as you're concerned, what can the government do to support those people working in these specific sectors, these sectors that will not rebound to the same levels as they were prior to the pandemic? Well, it all depends on how the pandemic evolves. It all depends on the opening measures. At the beginning, there was no choice. We could not choose between the economy and health. I think we all agree on that. But I think Quebec, we've also seen the experience. We had almost complete lockdown. We saw that it certainly helped, but it wasn't a magic solution. And I think in the coming months, there might be a bit of a comeback. We'll have to make sure that we have the proper health measures in place, but we really will have to choose the best measures. Perhaps wearing a mask is the best protective measures. But of course, if you keep those 2 meters distancing, of course, then you cannot go to a cinema and restaurants. All of these businesses will have to find a means of coping. For the time being, I think we need to find the best means of achieving the right health outcomes, all the while sending specific messages to these specific sectors. They're opening up now, but there is still complete uncertainty, so it will be very difficult. So I think it's going to be important for them to benefit from good financing. But right now in Quebec and elsewhere in North America, we are in a labor shortage position. So some people will be losing their jobs, but perhaps we have a possibility of sending them to another sector. And to send them to other jobs, certainly this will require a certain amount of adaptation. In Quebec, for instance, a lot of companies would limit development because they didn't have enough labor and they needed highly trained labor. So perhaps these companies might take over from those sectors that will be seeing a gradual decline. But there might be surprises. We've seen retail stores since the reopening. There are a lot of people going in. A lot of things will change. I think that telework is here to stay. But we might be surprised, and people might start to travel more quickly than we had thought.
You'll get a second round anyway, Gabriel, I think. Going then to Mr. Julian, and after that, Mr. Morantz. Peter?
Thank you very much, Mr. Chair. Thank you to all our witnesses. We hope that you and your families are safe and healthy through this pandemic. I am very anxious to ask you some questions, Mr. McDonald, and thank you so much for your presentation and the information that you've brought. Mr. Polyev has asked questions about banking support. That's great. I feel like he's starting to shift away from traditional conservative ideology. And of course, I think the lessons learned from the last crisis are important. So when the Harper government was in power and we went through the financial crisis a little over a decade ago, what is your evaluation of the overall supports offered to the banking sector? Were there conditions to that? And what are the lessons learned?
Mr. McDonald.
You mean conditions during 2008 or conditions during the present? Yeah.
For the bank supports that were put into place, what's your evaluation of the amount? And what were the conditions attached to that, if any? And what are the lessons that from that those supports that you think we need to think about this time around?
Well, there were few conditions, as there are this time around, in terms of accessing some of those supports. The programs were actually, in some ways, quite similar. The Bank of Canada, particularly engaging in large-scale repo operations with the banks, CMHC itself engaging in mortgage buybacks, and then many of the Canadian banks accessing American facilities as well through the Federal Reserve. This time around, during that last period, we had supports, maximum supports, I think, topped out in the $130 billion range. Where I'm sure, I haven't really done the full numbers here. I'm sure we're in excess of that this time around. Although what the banks are using is very different. And so this time around, the Bank of Canada's repo operations have been much more substantial. And there's been almost no take-up of CMHC's mortgage buyback program. In stark contrast to what happened in 2008, where it was the complete reverse, and there was much more interaction with the mortgage buyback program. Now, that program continues, and so there may well be some. The deferral of mortgages, of 14% of all mortgages in a deferral situation is extraordinary. That will presumably go down to some degree between now and September, but it may well be that if deferrals continue, the banks may be inclined to send more of their mortgages to CMHC if they start to go bust. In that regard, I mean, I am, I think it is positive that OSFI's rules this time around in terms of limiting share buybacks from the big banks. I mean, that has been a positive change. I don't think the capping of dividends and executive pay really does much, in the sense that 3 of the 5 banks already had increases in place. And so in many cases, those dividends will have increased in any event. I'll leave it there.
Yeah, thank you. But you raised the point, and in your presentation, which was excellent, about, for example, the prepayment penalties as people are emerged and not able to keep up their mortgage payments, the penalties and fees and compound interest charges for mortgage deferrals, the fact that we haven't seen the banking sector do anything like certain credit unions, Van City and Community Savings, that have dropped their interest rates to 0. What are the impacts when we provide so much support to the banking sector, but there's no responsibility to pass that on to people that are struggling, small businesses in my area, people that are struggling with consumer debt, people that are really having difficulty make ends meet, but it appears that they're just going to be part of the windfall profits that go to the banking sector?
The deferral program itself is premised on OSFI's exemption of the banks in terms of increase. I mean, what would have otherwise happened is that these loans would have been considered non-performing, and the moment they become non-performing, then all of a sudden the banks need to put up more in terms of capital to back them. Not to say that those people are bankrupt, just to say that the banks need to put up more money to back them. And as a result, those are tangible increased costs for the banks, particularly when, in some cases, 18% of all mortgages are in a deferral position. And so this change to the OSFI rule that provides material benefit to the banks allows for this deferral program. Now, I mean, I would certainly argue that this benefit that OSFI has provided to the banks could be used, or that committees like this one could request that the banks, in trade for this rule change, defer penalties as well as interest charges over the period of the deferral. This would be much more important for credit cards and lines of credit. It could be useful for mortgages as well. I mean, I think that we haven't really encountered this yet because the deferral program is in place, and so anyone who had difficulty paying a mortgage would go into the deferral program. It's really, I think, when the deferral program starts to wind down that we'll see this start to play a much bigger role, and that is the penalties for prepayments of mortgages. This is particularly true for fixed rate mortgages. It exists for variable rate, but they're lower in general. And so I think that in preparation for that, this committee could discuss this with banks and encourage them to waive most or all of the penalties of prepayments of mortgages as Canadians attempt to downsize, in essence. If job losses that they thought were temporary become permanent, the deferral period is over, they still don't have a job and they need to downsize, I think we need to make it as easy as possible for people to do that without undue penalties that would have to be paid to break mortgages.
Thank you so much. And the $5 billion that banks have made so far during this pandemic, I think, is something that the public certainly observes. The PBO has just produced a report that is shocking, I think, to most Canadians, showing the concentration of wealth being much, much higher, as I'm sure you're aware, than the former government statistics indicated, 25% of the wealth in the hands of the top 1%. Do you feel that one of the things that we need to do to as we come through this pandemic and out of this pandemic is envisage a wealth tax on that massive concentration of wealth? Certainly, the Broadbent Institute did a opinion poll, and even the majority of conservative voters believe now in a wealth tax. Do you think a measure like that could make a difference to starting to hit this record level of inequality that we're seeing in our country, and build a broader-based, more equal society?
A fairly tight answer, if we could, Mr. McDonald.
I don't think we're at the stage yet of discussing increases in taxation, but I think that we will soon be at the stage of discussing cuts in programs in order to reduce deficits, particularly provincially, but also potentially federally. And so, I mean, you can balance the books two ways. You can increase taxes or you can decrease expenditures. And so I think that new thinking around taxation, particularly a wealth tax, is certainly one way that we could increase taxes instead of cutting expenditures, which is the other choice. And I think we will see increasing pressure in the fall to do that.
Okay, thank you both. Before I start the next round, I would remind people if they do have a key point they want to raise when somebody else has given an answer, raise your hand. I may catch you. I can't see everybody on my screen at the same time, but raise your hand and we'll try and get you in. We'll go to very strict 5-minute rounds so we can get more people on. Mr. Morantz, followed by Mr. Fragascatas. Marty?
Thank you. Mr. Porter, I want to ask you a few questions. Recently, we had the president of CMHC on, and he had talked about tightening underwriting requirements for residential mortgages, and then shortly thereafter they did it. I'm just wondering if you agree with those changes.
So it's very interesting. In the early stages of this downturn, we've seen the housing market essentially locked down for a while. We saw almost an identical decline in sales and listings. So there's been very little change in pricing. Before this all began, it actually looked as if the housing market was on the edge of overheating in some key markets like Montreal in particular, and to a lesser extent Ottawa. That, of course, is no longer a concern. I still think that given the lengthy workout that we're going to be looking at over the next year or so, there's probably more downside risk than upside risk to the housing market. The measures that have been taken so far are relatively modest, but I would push back against tightening up a lot further, until we see the market settle out over the next year or so. I think there's just too much downside risk to embark on really tough tightening measures at this point.
Yeah. And one of the things I'm having trouble reconciling is you've got CMHC on the one hand tightening underwriting requirements, and yet and I'm not arguing we shouldn't have the emergency programs, but through the BCAP programs, you've got banks that are, commercial loans are either being joint ventured with the federal government or guaranteed. And so loans are being made that wouldn't be normally made under typical circumstances. Can you reconcile for me why the two different approaches? Why is one branch of government tightening their underwriting requirements and essentially another branch loosening their underwriting requirements at the same time?
I can't necessarily reconcile that. I understand that some of the tightening measures that were introduced by CMHC are of a longer term nature. I think at this stage they're just trying to protect potentially the most vulnerable debtors from getting in too deep. I don't think it was necessarily aimed at the broader macro housing market.
Yeah. So just to move on, wanted to ask you about the credit rating, Canada's credit rating, if you have any views on that. I know from my time on City Council, we had to meet with the credit rating agencies, and they didn't really care much why we were in debt. They just cared about how much we were in debt and whether our balance sheet could support it. Are you concerned that, and again, I'm not arguing against the emergency programs, but reality is that Canada is going to be hitting over $1 trillion in net debt probably before the end of this fiscal year. Do you think that our credit rating might suffer?
Mr. Porter?
Well, I think your first point, thank you. I think your first point is an accurate one, that the ratings agencies really aren't concerned about why a borrowing entity gets into a situation. They're just looking at the end result. We've already seen that, during the worst of the pandemic, some ratings have already come under question. There actually have already been some sovereign downgrades in the last month or so. So it's certainly Canada's not immune on this front. I'm sure the ratings agencies will take a long look at every sovereign borrower because of the dramatic changes that we've seen in fiscal policy. But I think the one thing I would point out is that we have seen significant deteriorations in government finances right around the world as a result of this.
Yeah, and that leads me to another question. I'm just wondering if you have a sense of what the tax base post-COVID might look like. With all the losses going on, that businesses have carry back and carry forward loss provisions. With the extraordinary losses being suffered, we could have a situation where the corporate tax base is seriously eroded. You could have companies in 2029 not paying tax because of their losses in 2019 or 2020. So is that something that you're concerned about? And if there is an erosion of the corporate tax base, what does that mean for the rest of the taxpayers in the country?
So it depends incredibly heavily upon the pace of the recovery and the strength of the recovery. I think that's job number one, first and foremost. But you do raise an important point. I mean, I think there's quite a consensus around what this year's budget deficit looks like. There's almost no consensus around what it looks like in year 2 or year 3, and I think that's again, that heavily depends on the recovery. I do think a lot of the emergency programs will roll off, and we will see a fairly considerable decline in the deficit next year, provided we do get the kind of recovery we're looking at. But I do think underlying finances have been wounded as a result of this, and we could be looking at a triple-digit budget deficit even next year with a relatively solid recovery.
Okay, we'll have to move on. Mr. Fragascatis will be followed by Mr. Cumming.
Thank you very much, Mr. Chair. I'll go to Mr. Wareham if I could. Jeff, thanks very much for your presentation. And you raise a number of ideas there, very nuanced, complex analysis of the current reality and potential ways forward. Give us again a 30-second, 45-second elevator pitch about the main objective that you're calling for. What is the aim that you are calling attention to?
Well, thank you, Peter, and thank you for the invitation today. I would say that the nuance is probably important to understand because it's actually something that's continued on through the conversation and through the questions. I believe that the private sector is going to be an incredibly important part of the recovery, and there are a lot of investors. My world, I talk to investors all the time, and there are a lot of investors looking for the opportunity to actively participate in the recovery, whether it's from a mercenary standpoint, looking at where they might invest and buy things at an inexpensive price. But there's also an altruistic side to it, where the private sector does want to help and pull together and support this. And I mean, there are massive regional disparities and so on. The reality is that what I've put forward is the idea of ensuring that the private sector has a voice, and particularly non-bank investment funds and organizations that might be trying to raise money for leasing, for factoring, for trade credit, and so on, have the opportunity to put, rather than simply asking for tax revenues to be put up and put into industries, perhaps government guarantees behind programs or fund-to-fund approaches where money's put into pools and then with government supervision is by private investors, by private members of the Canadian society, put out and worked in private-public partnership to invest in areas that small and medium-sized companies that are being so substantially damaged by the crisis.
So give me a concrete example. Company ABC finds itself in a very tough spot. What you're calling for? What does that? How does that manifest itself? Who's involved? How does it work? How would it be executed in terms of helping economies out in the recovery phase?
Sure.
Helping companies and the economy, I should say.
No problem. I think they're two pretty closely interrelated things. So, Peter, a simple example would be a manufacturing company that their clientele are not 1,000 buyers, but 5, 6, 7 buyers, and a customer that they've dealt with for years may have always paid on time or 30 days, 40-day terms. All of a sudden, as a substantial crisis on their hand, that trickles down from another customer problem and can't pay an account receivable. Well, a company that may be profitable, may be making sales, may have a good workforce, be strategically critical to a region that's been impacted, all of a sudden may end up facing insolvency simply because a customer is unable to pay. So an example of one of the core elements of what I put forward was the idea of setting up a factoring program. And I specifically suggested using our 263 community futures officers around the country, who are closely connected to the economic development areas, and specifically know who the key operators are in their own markets, working with them, having a pool of funds that's available for private investors to put forward to help with factoring. Similarly, an awful lot of our professionals, like dentists, for example, are dramatically affected by the crisis because they're, a key part of their business is the dental hygiene area. Well, if you really look at the details of what's being done to dental practices and what they have to spend to set up to handle the aerosols that come out of spraying water in people's mouths, dental practices I think are going to be one of the areas that are worst hit that people aren't really talking about because the costs are enormous.
Thanks very much, Jeff. I appreciate it. I think I got 30 seconds left.
You got a quick question. Go ahead.
What would you say to those who would put it back to you that, the Bank of Canada could organize something like that, or the banks could lead the way there? What is your response to that argument?
Well, I'd actually say that the banks have a very important role to play because, as I touched on in my presentation, their syndication departments have become somewhat of a, no disrespect intended, an old boys club that are primarily syndicating their own products out through investment advisors. And when they represent 80 to 90% of the investment assets, really what they need to do is wave the flag and get on side with with programs that are driven by investor demand to get out and support private industry. And the government has a role to play in perhaps putting a guarantee with some oversight. The banks have a role to play in getting their investment advisors and their syndication departments behind it. But there are a lot of good ideas out there, and they don't simply extend to the bank-owned investment firms.
Thank you.
Okay, thank you. Thank you both. Going to Mr. Cumming will be followed by Mr. Sabera. James?
Great. Thank you, Mr. Chair, and thank you to all the witnesses for being here. I'll start with Mr. Perreault. In a report that you did last month on the housing market, you estimated that the rebound will be quick, partially because of rebound in immigration. I'm now wondering if you would change that prediction at all, given the latest changes that CMHC has announced for the tightening up of credit. And I might want to also send that to Ms. Cooper as well.
Mr. Perreault?
Yes, sir. Thanks for the question. So no, we wouldn't change that. Our perspective on the CMHC changes are essentially that they're moving out of a market that is going to be serviced by the private sector providers. So it probably, it might have at the very margin an impact on housing market activity in urban centers, but we don't think it's going to have a significant impact, as I said, because they're basically freeing up space for the private sector folks to go in. Whether that was the intention or not, I think that's what's going to happen. The bigger issue on the housing market from our perspective is simply the supply-demand imbalance, which is, the housing market in Canada remains generally undersupplied. Population growth has been really, really strong. Through COVID, there's been a slowdown in construction activity. So these factors are going to conspire, if you will, to, put us in pretty good standing when we kind of reopen and folks are more comfortable going back out. And that's part of what you're seeing, I think, in some of the housing market activity that we're seeing in June and May, which is, there's a sense out there that folks need to jump on a property while they still can, because there still is a shortage, generally speaking.
Ms. Cooper, do you want to add anything?
I do. I think the immigration issue is a very important one for the economy as a whole, and certainly for the housing market specifically. And permanent residents in Canada are typically not welcome at the Canadian banks, particularly new Canadians. And they are going through alternative lenders. They're borrowing money outside the country, and they're also going into the private sector. And our assessment is that the CMHC changes will have very little impact.
Okay, thank you. And Mr. Porter, you were quoted, I think, that the recovery would be bumpy and that there's never been a recession as widespread as the current coronavirus crisis. So going into this, we started to see a slowdown in growth, and in fact, and quite fueled to a large extent by the resource sector. How concerned are you of this recovery? How long it's going to take to get any kind of growth rates again, given that we've had the coronavirus, and then on top of that, softening in the resource sector and the markets?
Well, of course, we're basically hostage to the virus over the next years or so. But I think longer term, the concern is that Canada's potential growth rate had faded to less than 2%. We'd seen very modest productivity growth in recent years, and if anything, the medium-term potential growth rate of the economy might be further dampened by this. If there are any encouraging points to make, is we've seen tremendous adaptation by business, by individuals of technology during this episode. To some extent, the future has been brought into the present. Whether it's kicking and screaming, people people have had to upgrade their technological skills, and perhaps that might help support productivity over the medium term. But I suspect that the end result of this is going to be slower medium-term growth as a result of the pandemic.
Time for a quick one, James.
Okay, quickly to Mr. Warham. Prior to coronavirus, I would hear from small businesses all the time that credit availability, access to credit has always been an issue. And I'm intrigued a bit with your notion of the private sector being able to fill some of that gap outside of the major banks. What kind of policy or regulatory changes do you think have to happen to make that happen?
I'd actually say almost none. Again, I'll point back to the fact that probably the biggest challenge is that, at one time, the pillars in our financial services industries were very distinct. And and again, not slighting the big banks, they're an important part of the success of the country, but with their acquisition of the lion's share of the wealth management assets in the country, their conservatism trickled down to compliance oversight. And there's enormous pressure on advisors and on investment bankers and so on not to put forward product that is risky to risk-averse investors. There is a way to manage that, but at one time there were literally hundreds of syndicated deals brought forward in Canada every year, investing in all manners of industry through debt, through direct investment in business, and that market has just almost completely dried up. So I think that it's the leasing companies and the factoring companies and so on that could use an infusion of capital. That infrastructure exists, and it's much less regulated than the banking industry, but it has been dramatically constrained by the move of investment assets onto the big banks' balance sheet. For valid reasons, but I think that, again, I go back to moral suasion on the government's part, encouraging the banks to get behind structured products and investment alternatives where advisors can talk to their clients about putting money back into the economy in ways that were done in Canada for 100 years.
Okay, thank you. Thank you all. We'll, following Mr. Sabera, we'll go to one question each from the following: Mr. Bien, Mr. Julian, Mr. Lawrence, and Ms. Kotrakis. Francesco.
Thank you, Mr. Chair. Nice to see everyone this afternoon. This pandemic we're in and the recession that's followed, obviously quite extraordinary, unique. I look here in my own riding of Vaughan Woodbridge. We have certain sectors and representatives of certain sectors doing quite well. The retailers, specialty stores, the CP Intermodal facility, a bunch of logistics operators that are doing very well have not been impacted as others have. But unfortunately, we have some bricks and mortar retail that has been impacted. I received a call from a young woman actually yesterday. She's going to be losing her job. One of the store that she works at, I don't want to name the entity, but they're closing down across Canada, and she's going to be looking for work. With that, she's probably going to be looking to upgrade her skills. In one of the budgets we brought in the prior session, the Canada Training Benefit was used and put forward to allow Canadians to upgrade their skills when they have transition. I think Ms. Cooper mentioned this, and I think another economist mentioned this as well. Looking forward, how important is it for our government to ensure that Canadians have access to the training to upgrade their skills, especially in those sectors where they're going to be late to come on and have been impacted severely? I'll throw this out to Mr. Porter first, and then to Ms. Cooper.
Mr. Porter.
I think it goes without saying it's incredibly important because barring an effective vaccine, we are looking at large chunks of the economy that will remain for a year, possibly 2-3 years. And as I mentioned in my opening statement, they tend to be sectors that punch above their weight in terms of employment. It could well be that eventually they get back to where they were in 2019, but we have to deal with the very real possibility that there will be large chunks of the economy that just are going to look different. Even
thank you, Mr. Porter. I do want to. I would like to go to Ms. Cooper.
Okay.
Ms. Cooper.
Yes, I certainly agree with Doug that this is an essential component, and it's one that can be done remotely. I mean, there's so much training available, and also what's happening is some large employers that have had to increase their payrolls dramatically, be it Loblaws or Walmart or some of the essential retailers, have gone to the businesses that have been shutting down and that where people can't work from home, and making those switches and training and anything the government can do to assist that. And it's just really matching is crucially important.
Mr. Severo.
Thank you, Chair. Thank you to the economist. To Jean-Francois, fiscal sustainability is something very important for me as an economist by training, someone who watches and reads the public accounts and the budgets year in, year out. We're obviously in a period of time where we need to support Canadians. We need to make sure that they don't suffer financial hardship and make it through this and build that bridge to when we get the economy fully ramped up. About 20% of the economy was taken offline or put in a frozen position with the pandemic and slowly going back on. So when we look forward in terms of Canada's fiscal sustainability and in terms of how we look at deficits going forward, because we need to continue to invest in Canadians, we need to continue to invest in Canadian infrastructure, broadband, hard assets like subways, roads and so forth. How important is it that we strike that balance about continuing to invest in key investments, not current consumption, but also maintain a good, strong fiscal balance sheet?
Thanks for the question. So one way to think about your question is to think about the starting point. So we got into this with a debt to GDP ratio of about 31%. There's no magic debt to GDP number there. The reality was we came into this and we had a lot of space to spend and to support our folks. And that was a result of a number of years of efforts to bring it down. So the advantage of having kind of a sustainable fiscal framework is that in times of need like this one, you can draw down on that and you can make the investments that you need to support your economy. So the key thing is that we've done that, and I wouldn't, at this point, I wouldn't worry about, it's going to sound odd for a bank economist to say this, but I wouldn't worry so much about, how quickly do we need to get things back under control, because the reality is that, we are going to be requiring substantial support, whether it's fiscal and monetary, for at least a couple of years. And it's just entirely too early to start thinking about, okay, when do we go back to balance? How do we establish a plan to balance? Because it's just not the right time.
Thank you. We're out of time there. Thank you, Francesco. I see Mr. St. Marie. A single question, if we could, from you, Gabriel, and one from Julian, and then we'll go on to Mr. Lawrence. Go ahead.
Oui, merci, Monsieur le Président.
Thank you, Mr. Chairman. My question is for the economists. Representing the Bay Street banks, there are 4 out of 5 here present. So when you look at the financial results from the big banks, we see that the profit levels are high. We're also seeing the very high level compensation of senior leadership. My question is this. I find that there is inequity in the fiscal position in the sense that the big banks use the tax shelters to optimize their taxes, and it's legal. Now we have the pandemic, we have economic measures that are costing a fortune, and of course all of this will have to be reimbursed. So what argument would you level if the government were to ask you, if Parliament were to ask you to no longer use these tax shelters in order to pay less tax to Canada? So, of course, my question is for Mr. Porter from the Bank of Montreal, Mr. Shenfield as well from CIBC, and for Ms. Cooper as well from Dominion, and Mr. Perot from Scotia. Thank you very much.
Okay, who wants to go first? I would say, Gabriel, these are not the presidents and CEO of the banks. These are the economists that work for them, but I'll let them answer how they see fit. We'll start with Mr. Porter.
Thank you. Thank you for letting me start. I guess what I would say is, we have to take a step back and ask what caused this downturn. What are we dealing with? It's obviously a health issue. It's not a credit issue. It's not, I think we should be looking at solutions at how best to get the economy to grow from this point. I don't believe that a lack of credit is at all the issue that the Canadian economy is dealing with, or the global economy. I think we have to remain focused on how best to recover at this point. We shouldn't be casting around for villains when the villain is obviously the virus.
Mr. Shenfield, your mic's on. Your mute's on. You hit the video.
I hit the video. Sorry.
There you go.
The banks aren't making so much money this year. For number one, banks might like to tell you, oh, look at how well we did excluding those provisions for potential future loan losses, but those provisions actually count against earnings. So first of all, this is by no means a banner year for banks. And remember that I think you mentioned someone has talked about senior bank executive compensation. I'd like to be one of those senior executives, but all of us are compensated at least in not small measure in bank shares, which are down substantially this year. So compensation levels will not be as rosy as the numbers you looked at for last year. I can almost bet that. And then finally, I would say that, it's not like taxpayer money has been poured into Canadian banks. Canadian banks have not come running to government for taxpayers' money. We've had obviously the Bank of Canada has lowered interest rates. That gives banks, and the OSFI has helpfully changed capital requirements a bit or loosened up some things, but that's creating lending room that the economy needed. These are measures designed to actually help our clients, which we're certainly happy for because we want those clients to prosper. But I think the premise of the question is that there's been some magic gift. Even if you go back to the recession of 2008, the main program that the government did was a program to purchase mortgages off of the banks, which let the banks, in effect, raise money more cheaply than they could have at the market at the time, because the market was very concerned that banks around the world were going under. But if you actually roll ahead and you ask, well, how did the government do on those mortgage purchases? They did just fine. They made money. They contributed to the government. So not everything is a handout.
We'll have to go to Mr. Cooper, followed by Mr. Perot, I believe, and get on to the next question. Ms. Cooper, fairly tight if you could.
Oh, I can make it very tight because I'm no longer a bank economist. I can tell you, though, that having a strong banking system in Canada is a huge advantage for the country. And we meaning the Canadian banking sector, outperformed the rest of the world's banks and cost our government far, far less money than in other countries. So, and it isn't a good year for banks, but I do agree there will be no tag days for the Canadian banks.
Mr. Perot. Thank you, Ms. Cooper. Mr. Perot.
Yes, I have nothing further to add to what has already been said. Thank you.
Okay, thank you. Then we'll go on to Mr. Julian. Peter?
Oh, thank you very much, Mr. Chair. I'm glad folks are proud of the banking system, but when we have a society where almost half the families are $200 from insolvency and families are in record levels of critical family debt, there's obviously a problem. So I think the emphasis should be less on making sure we have a great banking system, a gold-plated banking system, and a lot more on actually helping the people that are struggling to get through this pandemic. But my question is to Mr. McDonald, and that is coming through the pandemic and coming out of the pandemic. One of the big problems is the fact that we have massive use of overseas tax havens. I questioned CRA on Tuesday. They admitted that they don't even have the tools to prosecute companies that are openly engaging in tax evasion through the use of tax havens. The Parliamentary Budgetary Officer, as you know, evaluates that at $25 billion a year that we lose that could go into education and healthcare and affordable housing, all those things that make a society great. So how important is it, since you framed the issue of either cutting services or of having a taxation system that actually responds to the needs of Canadians, how important is it to actually get a grip on these overseas tax havens? And how important is it to do things like the wealth tax and making sure that we have a fair tax system in this country so that we're not going to the point of cutting services, but rather enhancing them, not only for a better quality of life, but also because it makes smart economic sense?
Mr. McDonald.
Well, thanks so much for the question, Mr. Julian. Certainly in terms of international tax havens, they exist because we allow them to exist. We allow them to exist in the sense that we don't require corporate entities operating in Canada to disclose where they declare profits, where they make revenue, and where they employ people in this country. And as a result, we can't tax them appropriately. If you are a Canadian organization in Canada, you can't play these sorts of games because you're required by law to declare where you employ people and where you make your revenue, and therefore you pay your corporate income taxes in the jurisdiction where those two things happen. So you can't just declare all of your money in the jurisdiction where the corporate tax rate is the lowest. Internationally, you can, and therefore we allow that. And so I think one of the big pieces is to, in terms of the closing these types of tax loopholes, is fundamental transparency about where companies that operate in Canada make their money and who they employ. And certainly their closure is a potential source of government revenue in Canada. At present, is simply being shifted overseas and no one's paying tax on it.
Okay, thank you. We'll go to Mr. Lawrence. Go ahead.
Thank you, and I'm glad I was preceded by Mr. Julian. I will ask about the flip side of that question. So, as we go through the pandemic, we've had a very difficult time. I would beg to differ a little bit on the importance of the debt, because when we look at unfunded responsibilities, the debt is actually close to $3 or even more than $3 trillion at 166%. But regardless, we've got high unemployment, we've got low economic growth, and I think that one of the keys to this, and you can agree or disagree, is the productivity and also of course, that of the private sector. And then in order to get ourselves out of this situation, both to pay off the debt and to get ourselves back to a higher level of employment, higher level of growth, we need to enhance productivity. And one of the drivers that government can do is reduce taxes, not increase taxes, to allow Canadians to keep more of the money that they work so hard for, to allow job creators to create jobs, to allow business owners to be successful. Am I incorrect in that? Maybe Mr. Schenfeld will answer.
Start with Mr. Schenfeld. Go ahead.
So no doubt, capital spending is important. It's a determinant of long-term productivity. So we have to have a competitive environment. I think that we've seen some of the challenges from jurisdictions like the US, which have lowered corporate taxes. Canada's are reasonably competitive in that regard, so we're not that badly off there. But I think your fundamental question is right. Ultimately, the standard of living of a country, which is the pie that we divide up. And I'm fully sympathetic with the idea that as we divide up that economic pie, we have to pay attention to how well the people at the bottom of the scale are doing. It's a very important feature of, I think Canadians all agree, in fact, on that. But nevertheless, the size of the pie matters too. And productivity is the key. We have a given population. Productivity is basically just the measure of how much we produce per hour or per person. That's the ultimate source of wealth in any country. And so government programs and decisions that impinge on productivity are key. But I would just broaden your question. It's not just about taxes. It's not that necessarily the lowest tax rate wins the day, because governments also provide infrastructure. They provide training. These are things that take tax money to raise. So it's a balancing act. The government has to have the right highways and roads to move our goods, for example. The governments have to have a good education system. They raise taxes to do that. So it is a balancing act. It's the full panoply of government decisions that affect output per person are really key to wealth when we think about the medium term.
Okay, I'm sorry, Philip. We'll have to end it with one question there and one question from Ms. Koutrakis because we've got 8 people on the next panel, so we got to start in time. Annie, a question there, please.
Thank you, Mr. Chair, and I'll be quick. My question is to Mr. Shenfield, and if Ms. Cooper can also chime in. What can the government do to accelerate our economic recovery, and can you specifically give some recommendations?
Mr. Shenfield.
So as I said, I think in my opening remarks, the single most important thing is actually about health policy. It's because what we're really trying to do here is, in terms of accelerating the recovery, is get both businesses and households comfortable with the idea that economic activity can resume without everyone getting sick. And so things like, do we have the right mask policy in place, for example? A major employer that we just had on one of our conference calls, a major real estate employer, had a policy that people using their bathrooms, for example, in their office towers had to have a mask, but then they were told by that province that masks weren't mandatory and that the builder basically couldn't impose them. I think we need to have national policies designed to put us on a common footing. That's the most important thing. And I'd say one other thing I don't read a lot about in Canada, but there is an international race not only to develop a vaccine, but to get your hands on it first. I think one of the most important things we're going to do again in the health area is let's make sure that, because it's going to be every country for themselves here. That's not just a Donald Trump phrase. We're going to have to make sure that Canada is not waiting for the other billions of people around the world to be vaccinated and we're at the back of the line. So that's nothing to do with banking. But in fact, this recession has nothing to do with banking either. It has everything to do with health policy. And then I would just add one other point. We talked a lot about extending credit. Actually, a lot of small businesses don't want to borrow. They're in debt already. They don't want to put more money on the debt side. And if we have a hole in our financial system, I would say it's more on the equity side. I think we need to come up with innovative ways for small and medium-sized businesses to actually have a better access to pooled equity funds, because that's what they really need. They need more equity, less debt. And even I would so go far as say we also need to think about when they exit that and try to go public. Our public equity markets have really shrunk in terms of new issuance. We've seen that almost disappear. In the heydays of the income trusts, and I know that was a bad word in Ottawa, we had lots of companies using that vehicle to go public, and that was a way for the owner to cash in. And it may have been a flawed way in part, and need to be thinking, but I do think we have to think more broadly about not just big companies, but smaller companies getting more equity into them.
Okay, last quick words to you, Ms. Cooper, and you'll have to close it off.
I just want to touch on something that we haven't mentioned yet, which are sectors that government can definitely help to grease the skids of economic development. Sectors that will be very important in the growth of the next wave of technology innovation are telemedicine, which we're all engaged in right now, big data, artificial intelligence, cloud services, cybersecurity, big government issue, and 5G. And compound that with, enhanced broadband and computers for everybody, inexpensive tablets for kids, all of that, very important.
Okay, that's an interesting a note to end on. Look, on behalf of the committee to all of our witnesses, we want to thank you for appearing today, for giving us your thoughts, your constructive criticism where it was placed to, and your advice for the future. So thank you, and we wish you well over the summer months. We will adjourn for 2 minutes and start with the next panel. The meeting suspended. Thank you. meeting number 38, the second panel for today at the House of Commons Standing Committee on Finance. We are operating under an order reference from the House of Commons on the government's response to the COVID-19 pandemic. Just to re-emphasize what the clerk and the folks on the translation booths said earlier, one of the difficulties with these kind of meetings is everything has to be translated. And when the interpreters are hearing in their ear and speaking over the top of what you're saying, the language has to come in very, very clear to them, or it's really, really hard in the head, to put it honestly. So if people could speak fairly slow and clear and into their mics, that would be helpful. Okay, with that, we do have 8 witnesses on this panel, which is more than usual. So I'd ask people if they could to keep their remarks to 5 minutes, as close to it as they can, so that we have time for questions. We'll start with the Canadian Steel Producers Association, Catherine Cobden, President. Go ahead, Catherine, the floor is yours.
Thank you, Mr. Chair, and members of the committee. My name is Catherine Cobden. I'm the president of the Canadian Steel Producers Association. And I want to thank you very much for the opportunity to share the perspective of the domestic steel industry on the impacts of COVID and our recovery priorities. Our member companies produce approximately 15 million tons of product annually, and we support 123,000 jobs in 5 provinces from Saskatchewan to Quebec. Our industry is an important backbone of our national economy. Furthermore, Canada's steel sector plays a strategically important role in the overall North American economy. We are advanced manufacturers of 100% recyclable product and a critical supplier to many other key North American sectors. Today, our industry, like so many others across the country, is facing unprecedented challenges as a result of this pandemic, and we truly appreciate the priority that all parliamentarians have given to tackling the pandemic. And we are very grateful for many of the economic measures that the federal government has introduced in support of Canadian businesses and our employees. Some of these have been absolutely invaluable to our members. As an essential industry, we continued to operate throughout the pandemic to supply our much-needed products to many critical applications. We are certainly proud of our small but important contribution in supplying steel for medical equipment and hospital-grade applications. However, the last few months have been exceedingly difficult for our members. We have seen a dramatic drop in demand for our primary markets, such as automotive, energy, construction, and many others. And our members have only been able to operate at about 60% or less of their existing capacity. On the job front, unfortunately, 10% of our workforce has been affected by layoffs. But this is actually a good news story, as these layoffs would have been by far worse were it not for the Canada Emergency Wage Subsidy Program. Our members thank the government and all of you for working together to see this program delivered quickly, and frankly, for the decision to extend the program until the end of August. Our industry views it as a critical lifeline during this unprecedented time. Moving forward, the steel industry faces a very difficult road on recovery. We're not expecting an immediate return of our business. It's not a V. We expect the next couple of quarters, frankly, to be a significant challenge. In that regard, we are urgently sharing with you ideas on how to recover the economy in a way that will support the steel sector's full participation in that recovery. A top priority for us is to protect our domestic market from unfairly traded imports. either from dumping practices or massive importations or other practices that harm our sector. The world has been stockpiling steel through this pandemic, and we remain deeply concerned about the wall of steel that is already beginning to surge into our market. It's causing injury to Canadian steel producers and will cause more. In addition, maintaining market access to the US is crucial for Canada's steel sector. The swift implementation of the new CUSMA, including the automotive rules of origin, is a tremendous opportunity for North American steel and our collective recovery. The North American automotive sector is a valued customer of ours, representing about 25 to 30% of all Canadian steel production. As the auto sector returns to operation, we remain ready and able to support that sector in meeting all the rules of origin obligations. COVID-19 has also taught us the value of strong Canadian manufacturing base along with the need for strong North American supply chains. We must carry this lesson forward as we emerge from the pandemic to ensure that manufacturing and the supply chain stay strong and resilient. For the steel industry, this includes considering how things like domestic procurement and infrastructure spending priorities could recognize the social, economic, and environmental benefits of using North American steel. Finally, another important aspect of our recovery is enabling investment that improves competitiveness, productivity, and supports environmental objectives. In today's context, Canada's steel industry is facing challenging conditions to attract investment. The Strategic Innovation Fund has been a valuable tool for our sector in incenting investments in the past. In our case, we saw $250 million of SIF funding leveraged to over $1 billion of project funding in the past. Given this demonstrated importance, we call for SIF's recapitalization as part of the government's COVID recovery response. Thank you again, Mr. Chair and committee members, for the opportunity to be with you today, and I'm happy to answer any questions.
Thank you very much, Ms. Cobden. We'll go next to the Canadian Federation of Independent Grocers. Gary Sands, the floor is yours. Gary?
Good afternoon. Thank you, Mr. Chair. I'm the Senior Vice President of the Canadian Federation of Independent Grocers. I would like to thank the committee for the invitation for us to participate in these hearings. Just to let you know that independent grocers across Canada serve in a myriad of communities in this country, particularly rural, remote, and Indigenous communities in which we are the only source for food for people in those areas. As such, independent grocers are a critical linchpin in ensuring food security for much of the country. Independents account for about $18 billion in sales, and there's approximately 6,900 independent grocery stores across Canada. Yet we compete on a landscape that is overly consolidated at the retail, wholesale, and at the supplier levels in a number of categories. At the same time, our members operate on overall margins of an average 1.5%, and that is much lower than other retail sectors. To stay on that uneven playing field, independents must differentiate themselves, and they do so by buying local, hiring local, supporting local initiatives, and living in the communities that they serve. There's been no playbook or manual that has existed that could have helped guide the industry through this crisis. In the context of panic buying, labor shortages, the closing of most of the food service business, plus increasing costs through the entire supply chain, this industry, for the most part, has responded very well by supplying groceries and supplies to Canadians. That being said, there have been issues around the issue of supply that our members have encountered over the last few months that need to be addressed within industry and government. Independent grocers, independent wholesalers have encountered problems getting access to some products. We understand that for some products, there's been a huge spike in demand, particularly when a customer wants to buy enough toilet paper to last them for the next 2 years. But when our members cannot access poultry, flour, eggs, or other essential products, including fair access to PPE, such as hand sanitizers and face masks, then that not only impacts the ability of that independent grocer to continue to stay in business, but the ability of those people, especially in those rural and remote communities, to access those essential products. That the situation we've experienced has put that at risk, and that is unacceptable to us. We hope it would be unacceptable to this committee. Too often over the past few months, we've had conversations with associations representing supply managed sectors or companies in the consumer packaged good areas, and with governments that were taken aback when we would explain that what people were saying was available in terms of supply was not what our members were seeing. Those were two different realities. So there are issues around distribution that need to be addressed and fixed. While panic buying has subsided, we could see a second wave, or at some point, some other pandemic or crisis could again arise, which means we all need to ask, what can we learn from the past few months? Again, I want to say that this industry, producers, processors, retailers, all responded with dedication and an exemplary commitment to ensuring Canadians had food and essential products. But there are learnings and things we can all do better in the event of another crisis. That includes consumers refraining from panic buying, but it also means wholesalers and suppliers have to ensure there is fair access to products for all retailers. And it means also the governments have to ensure there are going to be mechanisms in place that allow our independents to access PPE supplies, both for the protection of their customers and employees. And as well, all ag and food ministries, federal and provincial, must end their entrenched and systemic preoccupation with on-farm to the exclusion of off-farm. They're very fond of slogans such as gate to plate or farm to fork, but the reality is, and it doesn't matter what party is in power, scant attention is paid to this end of the supply chain. Lastly, Mr. Chair, I want to conclude by just pointing out how the reality for all small and medium-sized businesses has changed and will change as a result of COVID-19. We know this because our members have been open as an essential service. We know what lies ahead for everybody because we're on that road right now. Increased costs to enhance consumer and team member safety through rigorous and stringent in-store cleaning, enhanced safety protocols, additional supplies of PPE, including installation of plexiglass barriers. These are just some of our new realities. And at least for independent grocers, because we're not part of the on-farm sector, unlike other parts of the supply chain, we've received no government financial support. And as well, this committee in particular should be cognizant, of the significant migration away from cash on the part of consumers to credit and contactless payments. This has meant and will mean a corresponding significant erosion of the bottom line of most businesses because of the increased percentage they must now pay in interchange fees. And since large chains pay much less in interchange fees as a percentage than a small and medium-sized business does, this erosion has a disproportionately deeper impact on those without the leverage of a Walmart to negotiate more favorable rates. It's naive to believe that these billions of dollars siphoned out of the pockets of those SMEs does not have a huge impact on what Canadians pay for goods and services. Of course it does. But with the percentage of credit transactions now so much higher, this will make it a much more difficult journey for many businesses on the road to recovery in the next couple of years. We would urge this committee, in the context of COVID-19, to recommend that the government revisit the current agreement yet to go into effect with the credit card companies to reduce fees to an overall average of 1.4%, that agreement needs to be revisited. The payments landscape is a much different one now. All of us need to work together to put this country back on its feet, and credit card companies need to be part of that solution. Thank you again, Mr. Chair and members of the committee, for the opportunity to speak to you today. We very much appreciate it.
Thank you, Mr. Sands. We'll go to the Association for Mountain Parks Protection and Enjoyment, and I'm not sure who's making the presentation, Mr. Back or Mr. Carlos.
I am. Good afternoon, Thank you. Good afternoon, Mr. Chair and members of the committee. Thank you for providing us this opportunity to appear before you and for the important work your committee has undertaken. It is much appreciated. We're here today to provide you with a picture of how devastating COVID-19 has been for businesses located within Canada's mountain national parks. We also have several recommendations proposed to the committee that would provide immediate relief to our businesses as tourism and revenues plummet. My name is Yanni Carlos. I'm the co-founder of Banff Hospitality Collective. We own and operate 11 restaurants in Banff. Joining me is Stuart Back, Vice President of Operations for Pursuit Banff Jasper Collection. Together, we co-chair the Association for Mountain Parks Protection and Enjoyment. AMPI is a member-based organization which represents over 1,000 businesses operating throughout Canada's 7 mountain national parks. Collectively, we employ tens of thousands of Canadians. AMPI advocates for accessibility and positive visitor experiences in these parks. We believe in healthy parks. Conservation is fostered when visitors experience nature in a deep and meaningful way. As recently as last year, our region welcomed over 5 million people and contributed $3 billion per year to Alberta's economy. Visitors to Banff alone generate about $250 million in provincial tax and $470 million in federal tax revenues annually. As economic diversification has become a priority in Alberta, tourism's contributions will only increase in stature. As a result, we are seeking to work with governments to do everything possible to support our industry as we navigate this difficult period. Excuse me. The formerly busy streets of mountain parks towns are nearly deserted. In mid-March, over half of Banff's residents, or an estimated 5,000 people, lost their jobs, and there's been limited recovery since. On the Victoria Day weekend, typically one of the busiest of the year, we saw an unheard of 92% drop in visitors. The local economies of Banff and Lake Louise are almost entirely reliant on tourism, with Jasper close behind. Nearby towns such as Canmore, Hinton, Pincher Creek, Invermere, Revelstoke, and Golden also rely heavily on the mountain parks and tourism for their economic well-being. Sadly, there's limited short-term relief in sight for our towns. A recent study by the Vanier Institute found 72% of Canadian families are unlikely to travel in the next year. Borders remain closed. Interprovincial travel is being actively discouraged, and flight capacities are a fraction of what they once were. 60% of visitors to Banff National Park originate from outside of our regional market. Businesses in mountain parks remain squeezed between federal and provincial guidelines. And perhaps most importantly, our business viability is built on summer visitation carrying us through the slower winter season. This was true even before the COVID-19 crisis. I heard someone say recently that losing the summer will be akin to having 3 winters in a row. The simple fact is we will need sustained support to survive. We remain solution-oriented and are deeply committed to our businesses in the Mountain Parks region. Our recommendations will provide immediate relief to the tourism-reliant communities where we operate. First, we ask that Parks Canada waive entrance fees to the national parks. This was done in 2017 for Canada 150 and resulted in an increase in visitation. Second, we recommend Parks Canada extend lease and license renewals and overholding terms. Local businesses are scrambling to reinvent themselves as guidelines, regulations, and visitor circumstances change daily. Extending lease renewals and simplifying terms will enable all parties to focus on recovery efforts. Third, we recommend government reinvest in guest experience and infrastructure to support communities within the parks and welcoming back visitors. Visitors coming to the mountain parks are seeking a connection with nature through a variety of experiences. Investing in infrastructure, addressing deferred maintenance, as well as our quantified infrastructure deficit will give Canadians a platform to strengthen their connection to the parks while also providing an important stimulus for our local economies. Fourth, we recommend making our parks global leaders in green and low carbon visitation by progressing plans for expanded mass transit and passenger rail connections. These projects will help reduce peak congestion, lower emissions, and protect the environment while creating jobs and economic opportunity. And finally, we ask that CEWS, SECRA, and the Parks Canada Rent Relief Program are extended for tourism and hospitality dependent businesses as long as travel restrictions and social distancing requirements are in place. This will create longer-term stability and certainty for our communities and facilitate keeping our people employed. We'd like to thank you once again for your time and attention to the very urgent issues facing our part of the country and our members. AMPI values this opportunity to help you to not only understand the devastating and long-term impacts the COVID-19 crisis is having, but to also bring you some immediate proposed solutions that we very much hope the Government of Canada will seriously consider and act upon. Thank you, and we welcome any questions you may have.
Thank you very much, Mr. Carlos. I come from a heavy tourism area myself, and it's not easy. Turning then to Fairness Alberta, Mr. Bill Bewick, Executive Director.
Thank you very much for the invitation to appear. It really is an honor to be here today before the House of Commons Standing Committee on Finance. While everyone's economies are in uncharted waters across Canada, after a 5-year downturn, Alberta's has been hit extra hard by the COVID-19 crash in energy demand, dovetailing with a price war between Russia and OPEC. It seems to most Albertans that if it was central or eastern Canada where a critical economic sector, or even a prominent company, was temporarily blown into the ditch by international storms, that the federal government would be right there with financial and other support. Thus far, all we've heard coming to Alberta is about $1 billion for reclaiming orphaned wells, as well as some nationwide loan supports that are hard for our energy companies to access. For perspective on that $1 billion, Albertans paid more into the $9 billion auto sector bailout in 2009. So what we've seen thus far feels a little more like a nudge into retirement than any kind of stimulus. And as our group, Fairness Alberta, has shown, Albertans have contributed so much to the rest of Canada, federal revenues in particular, that we believe it's both fair and also in the interest of the federal government and the national economy to give more consideration to the particular issues in our province as we struggle through the worst of this extended downturn. To raise awareness across Canada, we have a billboard right now in Ottawa on Rue Saint-Laurent, noting that Albertans have made a net contribution of $324 billion since the year 2000. Every time the government repeats the fact that Canada is in a fiscal position to weather this storm, I think of that $324 billion cushion provided by Albertans. This amount works out to about $320,000 net contribution per family of 4 over 20 years. It's really a staggering number. And for the members of Parliament here not from Alberta, that's meant about an average $42,000 benefit to the families in your ridings. And just for clarity, these aren't just boom time dollars. In 2017, when we were well into this economic downturn and provincial revenues had just dropped 20%, Canada still got a net benefit of $15.2 billion from Albertans, or $15,000 per family of 4. Now, I do want to be clear, Albertans are proud and grateful for their ability to contribute to the country, just as any province would be. But I believe there's 2 things that have stoked discontent in Alberta that you should recognize as you consider strategies to pull Canada's economy out of this COVID-induced lethargy. First is the many ways that federal programs, spending on goods and services, and provincial transfers all directly, unfairly direct spending to other provinces. And the second is the target that seems to be on our backs despite these contributions. Regarding the first point, the annual $15 to $27 billion net contribution from Alberta has many elements that we at Fairness Alberta are diving into. Consider provincial transfers. The size of the health and social transfers mean that Albertans are contributing another $3 billion more than we get back for services that are constitutionally provincial. And we just wonder if that's fair, given the equalization program adds another $20 billion on top of that. Or as the Library of Parliament document that I sent you earlier today shows, the federal government spends far less on goods and services in Alberta than any province. We fund about $11 billion of the total, but even with 2 large military bases and so many Indigenous communities, only $5 billion gets spent back in Alberta. Is that $6 billion difference fair? And the second point that fuels anger and discord is, of course, the target placed on the diverse, integrated, world-leading energy industry that has driven our large fiscal contribution. And while competitors internationally innovate and thrive, even amidst lower prices, our industry has faced fights over pipelines, tanker bans, and GHG-related policies that create large competitive disadvantages. The result has been investment and jobs sent to regimes with far worse environmental or labor standards. Russia recently announced a $155 billion new oil and gas megaproject. That's almost exactly the amount Alberta has had cancelled or postponed in the last decade. This is not progress. So to conclude, it's critical that you think long and hard about the economic impacts of the policies being considered, particularly things like the new clean fuel standards that might cripple the natural gas sector, as well as any stimulus funds and how they are directed. But I also ask you to use the lens of, is this fair to Albertans? Is this unnecessarily undermining their children's chance at a future prosperity, when over the last 2 decades we've used so much of their prosperity to strengthen Canada? We need every province operating at maximum capacity if Canada is going to recover from this COVID crisis. Please remember what Albertans operating at a high capacity have meant to this country in the past, because with your cooperation, we can help make Canada stronger than ever. Thank you very much for your time, and I look forward to your questions.
Thank you very much, Mr. Bewick. Turning then to the Fédération Nationale de Communication, Ms. Pascale Saint-Onge, accompanied by Sophie Perron.
Thank you very much, Chair. I'm very happy to speak to you on behalf of my group. I'm going to give the floor to my colleague who will be going through some of what we do. Yes, can you hear me clearly? Yes? Yes, is the sound okay? Do you hear me? Thank you. Thank you very much. I'm Sophie Préjean. I'm president of the Artists Union. The Union des Artistes represents some 1,800 active members, actors, singers, directors, dancers. I won't hide it from you that COVID-19, this pandemic that we have been living through, has affected 100% of our members. All artists have been affected. All performers have been affected. Some have gotten along through it better than others, but everybody has been hurt. That is why the CERB has been something so very necessary. It has been healing potion to help us. And I want to say thank you on behalf of my group. It has been something that has been very, very good for us. It has shone a light on the precarious situation of artists and performers in our society. Each time, the CERB, it was for 8 weeks. It's being extended several months. It was now extended for 8 weeks, and that will help. But we would like to see it possibly become somewhat more permanent, how it could help all our artists, all our performers who live in such precarious situations. In some sectors, I hear on the radio that the CERB could become somewhat delicate. It might even have a negative effect on our society because workers might prefer to stay on CERB rather than to return to work. But I can assure you that in the arts sector, that type of person does not exist for a very simple reason. The longer you are isolated, the longer you are not seen, the longer you do not work, the more it plays against us. In other words, you have to be seen, and therefore you have to work to be seen. The people are ready to go back to work in our association. Yes, we thank you from the bottom of our hearts for the CERB, but one day we will have to address the elephant in the room, and that is some sort of support that will be enshrined, that will be permanent to help our artists in Canada, in Quebec. It could be envisaged in this way. It might be some sort of income that could perhaps top up the CERB, yes, if you have a certain level of income, and these two possibilities, a top-up or an ancillary type of income that could be added to the CERB, which we feel would be one of the possibilities for a solution, and we would support that. That being said, I'll give Pascal the floor, who will be completing my thoughts. Thank you. I represent more than 6,000 persons in my association, the arts, cultural, we have, and we represent people, artists, freelance journalists, and so on, cultural and media workers who have really borne the brunt of the COVID pandemic. Most of the media have seen a high number of layoffs, but for independent journalists, I would say that the large majority of them have lost their jobs. And so the CERB certainly is something that can help them. COVID-19 has been a pandemic that has struck certainly the media industry, but also the whole of the arts industry. A few thoughts now about freelance or self-employed workers. 30% of them have had to suffer great losses. This is not going to be reabsorbed easily. We want to thank, of course, the government for the speed with which it reacted and bringing in the CERB. We want to thank you also for extending for 8 weeks the CERB, but I would also invite you to think about ways in which it could be envisaged in the future to become a greater help. I know it will take time, but for the media, this has been just dreadful for income. I will stop here. Sophie and I will be very happy to answer any questions that you may have.
Thank you very much to you both. Turning to the independent broadcast group, Joel Fortune and Luc Perreault. I'm not sure who's making the presentation, but go ahead, introduce yourself. Mr. Fortune? Your mic's there you go.
Yeah, thank you, Mr. Chairman.
There we go.
My name is Luc Perreault, Strategic Advisor for Stingray, a Montreal-based company which owns and operates a portfolio of broadcasting and music-based services, including Stingray Music, available on cable and satellite and through various applications. We also own and operate over 100 radio stations across Canada. We're a global company active in 103 countries with over 1,200 employees worldwide. This requires a lot of gymnastics because I've got a few languages in there.
I'm appearing before you on behalf of the independent broadcast group, the IBG. I'm accompanied by Mr. Joel Fortune, who is the legal advisor for the IBG. Our association represents 10 independent Canadian areas of broadcasting in TV, radio, and digital broadcasting throughout Canada.
COVID has hit industries that depend on advertising very hard. We estimate that the broadcast advertising market has shrunk by 50% or more since January. Before COVID-19, the Canadian ad market was already challenged by the growing dominance of large non-Canadian digital platforms such as Google and Facebook, which are cutting into the broadcast ad market, and much like for the newspaper industry. COVID-19 has made the situation much worse. You also need to consider the high levels of concentration of ownership and vertical integration in our domestic market. The small numbers of the same companies control a large portion of broadcast revenues in all business lines via their multi-platform assets.
For an example, in 2018, 4 large Canadian enterprises held, Bell, Rogers, Shaw, and Quebecor, held 73.4% of the $86.2 billion generated by the media in Canada. The 5 largest BDUs in Canada represent 88% of the sector's revenues. These same companies, these same enterprises represent 91% of the income for conventional Canadian TV, private TV rather, and 83% of other services.
While independent broadcasters such as Stingray represent a smaller segment of the business overall, we're still fundamentally very important. Independent broadcasters represent a fully 40% of direct employment in the Canadian broadcasting sector. We represent 69% of jobs in commercial radio, of jobs in discretionary television, and 14% of jobs in conventional television. And there's a multiplier effect as well. In a recent study, it was estimated that the independent sector accounts for more than 28,000 full-time positions annually in Canada, to our direct operations and to our production and international distribution activities. This is why we strongly support the extension of the Canada Emergency Wage Subsidy. The CEWS has been critical for many independent broadcasters to maintain employment levels, especially for businesses exposed to the drop in advertising revenue. We also have proposed additional measures also targeted to our industry. First, we propose an enhancement of the existing tax deduction for advertising on independent Canadian broadcasters. The deduction would be increased to 130%. This would help to level the playing field in an environment that heavily favors Canada's largest broadcasting group. Second, we support the extension of the news content tax credit developed for the print industry to the news programming produced by independent broadcasters. Third, we support the reimbursement of the 600 megahertz transition costs for independent broadcasters. These costs are being incurred to free up spectrum for other uses, including mobile. All of Canada's largest media conglomerates also operate mobile phone businesses. They will benefit from this transition. Independent broadcasters bear the same cost, but will not see any benefit. They should be compensated.
We know that other initiatives have been proposed to support our industry. For example, excluding tax breaks for ads that are bought on digital platforms, foreign ones. And we agree with that. That would help. Thank you for listening to us today. We're ready to answer any questions you may have.
Thank you very much, Mr. Perreault. And to the second last panelist, the International Alliance of Theatrical Stage Employees, John Morgan Lewis, International Vice President, and Erdin Rashpan, Executive Director. Go ahead. I believe you're muted there, Mr. Lewis. Go ahead.
I'm off now. Thank you.
Okay.
So I'm speaking on behalf of the IATSE, which is the largest union in the entertainment industry, representing over 150,000 technicians across North America, including 26,000 in Canada. Our members work in both the film and television and live performance sectors. We are the cinematographers, set dressers, scenic artists, carpenters, stagehands, hairstylists, costume designers, and just about every other behind-the-scene position you can name. As you've heard, our industry was the first to go down, and it will be the last to come back, particularly in the live performance sector. IA members in Canada are experiencing wage losses in the range of $120 million every month. Due to the freelance nature of our work, fewer than 2% of our members are receiving support through the Canada Emergency Wage Subsidy. Many are contract workers and not eligible for employment insurance. And so the only support available to a large portion of entertainment workers has been the CERB. And I want to express my sincere thanks to the Government of Canada for the creation of this benefit. It has truly been a lifesaver. I was relieved to hear this week's announcement of that CERB would be extended for 8 more weeks. but I need to make clear that the industry is a long way off from being ready to reopen. Most theaters will not be reopening until the spring of 2021. Live performance cannot restart until government okays large crowds, and workers will need the CERB extended until the industry is allowed to reopen to full audiences. Alternatively, the implementation of a universal basic income would also address support as well as retention, particularly in retraining workers who are just starting out in our industry and whose employment is typically more sporadic. The majority of IA locals belong to CERP, Canadian Entertainment Industry Retirement Plan, which is a group RSP plan with $700 million in assets. We have requested the Department of Finance and Canada Revenue Agency to create a limited window of emergency relief by allowing repayable RSP withdrawals, like what presently exists under the Home Buyers Plan and the Lifelong Education Plan. This emergency relief mechanism would have the benefit of making cash available to Canadians in need. And like the Home Buyer Plan and the Lifelong Education Plan, this temporary program would take the form of a repayable loan, and the funds would be made available between now and December 31st, 2020, or extended due to the pandemic. Prior to the pandemic, film and television production levels in Canada were at historic highs, fueled in large part by the increase of foreign service work and the dramatic increase in industry capacity and infrastructure. The industry has been working collaboratively to ensure that we are ready to return to these levels and even higher when work resumes. We should not be content with simply returning to those previous levels of production. Now is the time for the federal government to partner with provinces to invest in this industry in order to bolster our capacity. The demand for audiovisual content, particularly on streaming sites, is growing worldwide, and Canada is in a unique position to take advantage of this growth. Our crews and talent are recognized around the globe as being world-class. Now is a time to be bold and work with our industry to expand our capacity to create good paying jobs for the future. And the last point I want to mention is a concern for the industry, and particularly the domestic producers, to secure insurance in an environment where there is a real risk of a production being shut down due to COVID. Without adequate insurance, the industry will not be able to reopen. Domestic producers have a proposal before the federal government, which, in very broad terms, is asking the federal government to act as an insurance backstop, whereby producers could contribute to a pandemic coverage insurance pool that would total $100 million to be administered by the federal government. The IA and other labor groups support this proposal with two caveats. First, that workers should be paid out first for any outstanding wages and benefits and should also receive some form of severance should a production go down. And a requirement must also include that safety is a priority. So the second caveat is that any producer taking advantage of the program must adhere to an industry negotiated safety protocol that ensures the health and safety of the cast and crew. And now I'll defer to Arden Rishman.
Go ahead, Arden.
Thank you very much. IATSE and Canadian Actors Equity Association are in a coalition along with our colleagues at the Associated Designers of Canada and the Canadian Federation of Musicians. And we've begun to work on some ideas for some additional short-term supports to our sector, and I'd like to share a couple of them with you now. They include relaxing restrictions on an arts organization ability to access funds in their endowment beyond those currently identified as unmatched funds, temporarily amending the Income Tax Act so that live performance ticket purchases are treated as charitable donations, devising and implementing federal tax credit incentives for live performance organizations, similar to the types of tax incentive policies that exist for film and television production across Canada, additional assistance to help attract live audience attendees by providing theaters with funding equal to 50% of the average of the previous 5 years' ticket sales so that they may reduce ticket prices in order to attract audiences. And lastly, working with all arts and culture stakeholders to design, implement, and fund a national marketing campaign aimed at encouraging Canadians to return to the various arts and culture venues as patrons and audiences. In these difficult times, people have turned to what we do for solace and entertainment. They have listened to music. They have watched artists perform online from their homes and streamed previously recorded theatrical productions in extraordinary numbers. The importance of arts and culture in the lives of Canadians has never been greater, and neither has the need for support to the artists who are providing that entertainment. We'd like to say thank you very much for giving us the opportunity to speak to you today on this important matter. And John and I, of course, would be happy to answer any questions you have.
And thank you both. Before I turn to the last panel witness, I'll give members a heads up on the speaking order for the first round. First will be Mr. Cumming, then Ms. Zerowitz, Mr. St. Marie, and Mr. Julian. So turning to Tridectic Limited, Mr. Shabursky and Mr. Marini. I'm not sure who's leading off. Mr. Marini?
Mr. Marini, yes. Hi, how are you?
Speak fairly slow and into the mic if you could.
I will. Good afternoon, honorable members of the Standing Committee on Finance. We appreciate the opportunity to talk with you. Thank you. Tridectic is a structural engineering company based outside of Ottawa in Arnprior, Ontario, where we design, engineer, and manufacture everything. Founded over 60 years ago as a space frame architecture company with projects throughout the world, Ontario Place Dome, the John F. Kennedy Library glass wall, the Melbourne Arts Centre spire, Tridectic was invited 40 years ago by the Canadian Mortgage and Housing Corporation to develop a foundation solution for permafrost soil for Aboriginal housing needs. We designed and manufacture a steel space frame foundation system called multi-point foundations to support buildings on unstable soils, permafrost, floodplains, and brownfields. The multi-point foundation works like a floating raft slab, protecting the structural integrity of the building despite the differential settlement of the soil. Since then, we've been supporting housing and commercial projects throughout Canada, the US, Norway, and Russia.
Now, recently, after the success of the multi-point foundation in the northern regions, in Alaska and northern Canada, the multi-point foundation was adapted to brownfield infill projects for low-income housing programs. And one of them was successfully implemented was in the lower mainland of British Columbia in Vancouver area. We developed with our modular manufacturer partners a housing program where we could install an immediate housing program to fill the need for local housing. And so within a matter of months, low-income housing was set up in brownfields in the interior of Vancouver. So we're promoting that idea. That's why we're here to advise the committee that the technology is available. Canadian technology is available to do this effectively. Some of our partners are in Alberta, so we try to help the Alberta economy in that respect. We use Canadian-made steel for our foundations. So we're supporting the Canadian, yes, Ms. Cobden, we are supporting the steel manufacturers and also the aluminum Canadian industry at the same time. We have an opportunity to grow even further and to assist the Canadian government in this unfortunate situation with the COVID pandemic. Some of our partners are able to develop rapid response buildings that they can be used in multiple avenues. They can be used as a triage center. They can be used as a housing facility. They can be used as a storage facility. So we're here to inform the committee that with the help, with their assistance and their inputs with our partners, we can help them be better prepared in the future and use these buildings for other projects. And it's very beneficial for all. It will help the Canadian economy because, again, we're using the Canadian steel, which is made here. We bring it into our Arnprior. We cut it here, we roll it here, we galvanize it here in Canada. And it then goes out, and it's not only in Canada, but we're actually working with housing projects even in California. So we are able to export our expertise and our technology to other fields. That's basically why we're here, to inform you and to advise you. We're ready to work with anybody.
Okay. Thank you, and certainly thank all all the witnesses for their presentations. As you can see, this panel is quite a mix of witnesses, but there's even a benefit in that for other witnesses on seeing seeing firsthand the challenges that other industries, other sectors, other individuals have across the country, and the challenge of finding a solution for that. We will have to go to 5-minute rounds instead of the 6, and we'll start with Mr. Cumming, followed by Mr. Erwitz. James?
Great. Thank you, Mr. Chair. I'll start with Mr. Bawick. You talked a lot about the discord in Alberta and the frustration that is felt from Albertans, even pre-COVID, because of the slowdown of the marketplace and the difficulties that the resource sector has seen. But we've heard from many witnesses how important that resource sector will be in the recovery for the country. And I've never known Albertans to want to take a handout. But can you maybe elaborate on what would help Alberta from a regulatory standpoint and non-monetary assistance that the federal government could participate with?
Mr. Berwick, you're muted, Mr. Berwick.
Wayne, it's Buick, not
Buick.
Berwick.
Buick, sorry.
like the car you drive.
Okay, thanks.
No problem. Thanks. Yeah, it's no secret that the lack of pipeline access and all of the hurdles that have come up, and then new hurdles that have come up since, and then more hurdles that the government is considering putting forward through Bill C-48 and 69. Clearly, there's just a huge problem with that, and that does mean that we then get all of our oil prices are discounted at a huge rate because we have a captive audience down in the U.S. that is our sole purchaser. There's that, and then the tech resources issue recently. There's just so much uncertainty. So everybody understands that Canada has always taken environmental responsibility very seriously. And the sector takes it very seriously. There just needs to be a clear path and clear goalposts that don't get moved, and the confidence that this time the government won't be changing the goalposts, so that we will get those investors back.
So if we can get that right, are you of the opinion that Alberta can come out of this and lead the country again and participate fully, both with transfers and with stimulating the economy by getting people back to work?
Absolutely. I mean, the oil and gas sector is actually down to only about 25% of our economy. We have diversified considerably over the last 30 years through various means, including having just lower regulatory burden and lower taxes on companies. So Alberta is raring to go. But of course, when you have the third biggest proven reserves of oil and it's a product that's highly in demand across the world, it's inevitable that that's going to carry a big weight in your national economy. So if we can get that functioning at a somewhat competitive level, then everything else is going to take off. I'm extremely confident about that. And we will be back to providing a lot of support to the rest of Canada in terms of jobs here for people that are underemployed in their home communities, or manufacturing jobs that spin off to those communities, and also just all the net transfers that our higher incomes are able to provide for the rest of the country.
And what are you hearing from the resource sector on the loan programs that have been, it was suggested days, then it became weeks, now it's months, and we still haven't actually seen the details on a lot of these loan programs. Is that adding to the frustration with the province and with that energy sector?
Yeah, I mean, the $1 billion that has been earmarked for potential reclamation is helpful. But as I pointed out, when you look at how much Albertans contribute to national revenues, we paid about 1.5 billion into the $9 billion auto sector bailout in 2009. So we paid more to help bail out Ontario's auto sector than it looks like we're getting to help our own sector at this critical time. So we certainly hope that there is more coming, but so far it's been pretty quiet. And then
Last
something
question,
else
James.
we've pointed out, Fairness Alberta, is that the Fiscal Stabilization Fund is also something that really needs reform, and retroactive payments have been unanimously agreed to by the premiers, and we hope that we see some action on that as well.
Go ahead, James. Yep.
So if we get this right, Bill, it sounds to me like a lot of that discord would fade if we can, if government gets out of the way and lets business get back to gaining market access, to being able to build up and do the things that Albertans want to do. Would that be a fair assessment?
Absolutely, that's the biggest part of it. I think also, though, we want to be able to be a massive economic engine for the country. We would also like to see some reforms on a couple of programs, though, to make the way that the funds are distributed around the country more fair. But certainly the first step is letting us get back to being a major source of wealth for the country.
Thank you both, Ms. Sirowitz and then Mr. St. Marie. Julie?
Great, thank you so much. And I want to say a huge thanks to everyone for their excellent presentations. My first question is going to be to the International Alliance of Theatrical Stage Employees, as well as the Canadian Actors Equity Association. Thank you for being here. I'm very blessed in my riding to have a huge community of artists, creators, and those who work in the culture industry. You both have done a wonderful job of articulating their stress, their worries, their concerns, and I think some of the great ideas that are coming out in terms of how do we proceed. I want to just delve down a little bit into your ideas. Mr. Lewis, you talked a little bit about retraining workers, and I would like you to maybe elaborate a little bit on this, just because I think it's important for us to understand. We do appreciate, and I think the comment you made is that your industry is one of the first to go down. It'll be one of the last to come back. And I think we recognize it's going to be some time before we actually see the full sector come back. And so I think we're trying to explore certain ideas. So if you could talk a little bit more about what you meant about the retraining.
Yeah, thank you. And yes, we do have, and I live in the next riding to your riding. So, and we do have many Toronto members, but technology is changing rapidly in the industry, both in theater and motion picture and television. And the ability to stay on top of that is crucial. And the ability, because we're growing so exponentially, the industry is growing leaps and bounds in many sectors across the country. And we are dedicating tremendous resources for training and for retraining to maintain people in the industry. Because the concern is if our industry continues to stay shut down, many of our members have transferable skills to other industries. We have carpenters, we have painters, they can leave and go work in the construction industry. And so the concern is if this is prolonged and there isn't support, we may lose crucial people in the industry as we come out of it and as we look to grow. And we now are developing training programs to attract diverse communities into the industry as well. And so with the COVID shutdown, we've had to put those programs on hold, like with XOTO and the Toronto District School Board, and the City of Toronto is a great example of that. And unfortunately, we've had to put a hold on that.
Mr. Lewis, you also mentioned, and I thought it was a good proposal in terms of partnering with the provinces to bolster, I think, audiovisual sort of resources in order to create some good paying jobs in the future. If you could elaborate a little bit on that, and then I have a couple more questions.
Right. So we are seeing a fundamental change in viewing habits around the world. The growth of audiovisual streaming services is not going to change anytime soon. And we are close in proximity. We are a friendly place for large US studios to go. One of the things that was holding us back is we didn't have a lot of infrastructure in the industry. We did, but it wasn't enough. So you've seen in the last number of years, a large number of studios being built in Vancouver, in Toronto, and other locations. And so we're seeing that, and we need to invest more in that infrastructure to increase our capacity. There are many large feature films that bypass Canada. We get a lot of television, we get a lot of features. We don't get the real what we call the tentpole features in Canada. And there's things we can do to tweak the tax credits. Listen, there's some provinces, Quebec, Manitoba, Ontario, British Columbia have been very aggressive on tax credits. When tax credits were first introduced, when Paul Martin eliminated the shelters and brought in tax credits, it was always envisioned to be a 50-50 split between the federal government and the provinces. It's no longer a 50-50 split. And so I think we got to look at refining that, because we have a capacity that we really can grow this industry. We're really at a tipping point where we can take this industry to another level.
Okay, and that's wonderful. And the insurance proposal that you had mentioned, David Weaver had also proposed that, and I know that has gone to the government. If you could do me a favor, Mr. Lewis, if you could please make sure that you submit that proposal to our committee as well, just formally afterwards. It just allows us to take that into consideration as we make recommendations. And the other thing I want to just give voice to, because I know this, I've heard this a lot. I know there's a lot of stress within the community around the CERB. I know that there was a lot of relief when it was extended for 8 weeks, and I do want to let you know that our Prime Minister has mentioned this, that there is an understanding that there are industries that's going to take longer to come back, and there's also an understanding that there are many workers who don't have access to EI, as well as we know that there's 3 million people without jobs. And so we do have to find some sort of ongoing mechanism to continue to support workers and to continue to support those without work in Canada. So I just want to make sure that I give voice to that. I do have, if I can, one quick question.
Very quick.
It is actually to Ms. Cobden from the Canadian Steel Producers Association. Ms. Cobden, I know you had mentioned about dumping practices and you were worried about that. My understanding is that one of our committee, I think Justice Committee, was considering C-17. There was a provision around steel dumping practices there. I want to know whether or not your association was consulted and what was the outcome of that, if you were.
Ms. Cobden.
Sorry. Thanks very much. Yes, in fact, we were concerned with the original proposal around that was related to the Special Import Measures Act that got included in a recent SEMA bill, a recent bill from Justice. We worked with our many members of Parliament, including our Steel Caucus and the chair of that caucus, and we were able to communicate our concerns. You know, essentially, I think it was just not thought through that the implications of this, in the sense that this was going to give a relief valve to imports and egregious imports, and we did not want that, obviously, nor did anybody else. So we're really happy that those provisions that were the worst for us got addressed. Obviously, the status of the bill is what it is, but the provisions themselves were removed that would have really caused a significant problem to the Canadian steel producers.
Okay, thank you. And I believe we're going to Ms. Devin. Or is it Gabrielle St. Marie? Ms. Devin?
Oui, merci, Monsieur le Président.
Yes, thank you, Chair. Thank you to my colleague, Mr. St. Marie. Thank you to our witnesses for all your expertise. As the spokesperson for the Bloc Québécois in Arts and Culture, I'll be dealing essentially with that sphere of activity. Very soon, of course, we're happy that the CERB was extended, but like Madame Préjean said, it's quite clear. And indeed, when we have consulted stakeholders, there was a general feeling that it may not be sufficient, this extension. So the essential of the economic exercise for artists and performers is in the summer. And they have to be able to make enough over the summer to put something away for the leaner months in the winter. That's how it works in arts and culture. This to Madame Préjean or Madame Saint-Onge, the CERB, if rapidly, very, very quickly, we could make the government understand that we could create a CERB that would be a special CERB, where it could be extended over time, and it could be an investment. This is a long introduction, but in 2017, $5 billion were generated by the arts industry in Canada. It's very interesting to have such large figures attached to this. So it produces even more than agriculture, and I was quite astonished by this. When you think about extending the CERB, but in terms of investment, economic investment for the future, because if this didn't exist, the $53 billion would leave a big hole in the government's budget. What do you think about that, to the two witnesses? I will start. Is that okay with you, Pascal? Yes. Clearly, it would be very good for our sector. I'm in the habit of saying when we talk about culture in Canada and Quebec, we think in terms of francophones, anglophones, but culture doesn't exist per se. It is the creation of humans before it becomes a national identity. So sometimes I get a little annoyed when people talk. They say, and I feel when people say that culture is the reflection of our nationality, our Canada. No, it is intrinsically linked with artists and human lives. We have to be very specific in our way of thinking, not just global in our thought. Culture. All right, who makes the culture? And very often, too often, it's said if you improve the socioeconomic conditions of artists, it's as if it were in a part of a major panoramic of existential thinking where this would happen. No, these are real people. These are people with families and with small children, and they have to provide for them. They have to earn a living. So there are a lot of people who are invested in culture who don't understand it. There's all these the various levels of the cultural sector where you have grantors, recipients of grants as well. You don't want all this multi-level way of thinking. You have to get down to basics. Excuse me for interrupting, but what do you think is the danger of losing artistic expertise in this situation? Because it's going to probably peter out in this economic difficulty. This is something that could happen. It would be the worst thing that could happen. It's happening now in the music sector. Almost all musicians have a second job. It's also in the hospitality area, too, I can tell you. Exactly. They're closed. Restaurants are closed. So all those people who have a power, a talent, what are they going to do? They're going to do something else. And that day, we won't be talking about identity or culture because there will be no more culture. But since we're in the Finance Committee, there'll be no GDP either. Thank you.
Anything, we're near out of time, but go ahead.
I'll be very brief. I just want to add to what was said. The fallout that you talk about is a cultural industry fallout. And it is something that the effect that the Canadian artistic sector has on investment in Canada. What you're saying about the losses that are being incurred, it is true. There are members of our association that are seriously thinking about changing what they do and working in other areas, creativity, diversity of voices, democratic endeavors, to be able to support the creation that inspires all of us. And all of this, of course, has consequences for the tourism industry.
We're at a time. We'll have to move on to Mr. Julian, who will be followed. I believe Mr. Greg McLean has joined us. He'll follow Mr. Julian. Peter?
Thanks very much, Mr. Chair. Thanks to all our witnesses, and we hope your families are safe and healthy. I'm going to start with Mr. Lewis. I represent part of Hollywood North in Burnaby, British Columbia, more studio space than anywhere else in Canada, and so IATSE is extremely important to our community, and I'm in constant touch with people from the sector. Jagmeet Singh is the neighboring MP, and we fought very hard to make sure that the CERB was extended, but that's only a temporary solution. And what you've done is outlined a number of things that should be the next steps. One of them is having that access to UBI so that artists and folks in the film sector are not worried about whether or not the next month everything is cut off. You've also talked about a variety of supports that can be put into place. How important is it that the government act now to make sure that our film industry and arts industry can thrive coming out of this pandemic?
I think it's crucially important. It's funny, when I was many years ago, a prominent left-wing politician, Hugh Segal, he talked about a universal basic income when at my university. And so, I think the time has come to kind of relook that, because I think it addresses issues for people working in the arts. Because there's always this vulnerability, and I think that's what my colleagues from Quebec were just referencing to. There's this constant. It wasn't just COVID. There's a constant vulnerability in earnings and how we undervalue and underappreciate people who work in culture and in the arts. And so I think this, if there's a silver lining, and maybe this allows us to kind of re-examine the notions of the value of people that work in the arts and culture industry. The time is now. We have great opportunity. You've seen in Burnaby the number of sound stages that are being built. That's not by accident. And what I'm hearing is that we need more. And so if there's a way that the federal government can partner with the industry to build more, that is what we need. There's ways that we can tweak the tax credits to bring even more work and to work with. I think there's a role for province and federal government in terms of this insurance issue, which is crucially important for domestic producers. They need that in order to start back up again. Without it, it's going to be a very precarious restart.
Merci beaucoup.
Thank you very much. My next question is for Madame Préjean. Ms. Préjean, my family and I are part of your partisans here on the West Coast. We followed your career. So thank you so much for your presentation. I want to ask you the same question. If you talk about the CERB, and if you could have something in place, a guaranteed minimum income for artists, to help our artists, no matter where they live in Canada, to help them get out of this crisis. A system does already exist in Europe. It exists. There are intermittent workers. I don't know how that works exactly, but they have a guaranteed minimum income. So, yes, this pandemic, what it has done, it's shone a light on the precarious situation of artists, whether it's on the East Coast or the West Coast. The precarious situation of creators. I think that we should be thinking about a proposal that can be lasting in time, that could be enshrined. It's terrible, of course, in the context of the pandemic, but let's look ahead. This experience has got to serve as an example for us. We have to learn something from it. We, at a certain point, are going to have to take a good hard look at the reality of the self-employed, in our society, that are really a second class of workers in this country. They have no social safety net. Thank you.
Ask my final question to Mr. Sands. You raised the issue of interchange fees. The other countries have have basically put handcuffs on the banks from gouging people. And I know many small businesses that are impacted by the high cost of access through interchange. How important is it that the government, given that they've provided about $750 billion in supports to the banks, that the government actually require the banks not to gouge small businesses on interchange fees?
Well, we feel very strongly about, I don't think there's an issue that's more important to all small and medium-sized businesses in Canada. I do want to start off by saying that the government has brought about a new agreement, which was to go into place in April, which has been delayed. And that was definitely an improvement over what the agreement that was in place with the previous government. But there's still much more to be done. And the gap that exists between what the Main Street small businesses in this country pay and what companies such as Walmart pay is indefensible. It's inexcusable. And, I just want to go back to grocery and just have members understand this, the context for this. These independent grocers, I'm going to have to pick my sector, but I know I'm speaking for all small and medium-sized businesses. But if independent grocers are margins of 1.5%, and the new agreement, which is supposed to come into effect, which is to provide an overall rate of 1.5%, and that's an overall rate because that's disingenuous because the rates are actually for premium cards drive that higher. How do you make money? How does a small and medium-sized business in this country make any money when your margins are so tight and the interchange fees? If Walmart can get 0.89%, why can't other small and medium-sized businesses in this country get the same? And we've never had a clear, concise answer given. There's always a deafening silence. But the amount of money that we're talking about is billions of dollars. And I'm saying to this committee, we need to take another look at this because in the post-COVID landscape, there's going to be a lot of potholes on that road to recovery. And we don't need the credit card companies putting up any more roadblocks. And that's what exists now. They have to be part of the solution. And if they're not, they're part of the problem.
Okay, thank you. Thank you both. We're well over time there. We'll go to Mr. McLean, followed by Mr. McLeod. Greg?
Well, thank you very much, Mr. Chair. I'm going to ask some questions, first of all, of Ms. Cobden. Excellent presentation, and my favorite witness usually at these meetings. So, Ms. Cobden, the first thing I have to ask you is about the customers of your members and where the actual products end up eventually. The Canadian steel producers, can you tell me what percentage of their production actually goes into the extractive industries in Canada?
Hi, thank you. I hope you can hear me. Sorry. Yes? Okay, great. Thank you very much for the question. Nice to see you again. In fact, as I'm sure folks are aware, the energy sector is an incredibly important sector, customer of ours. So yes, it's one of our top three. So markets for us are the energy sector, the automotive sector, the construction and infrastructure sector. All of these sectors are extremely important. So I do want to thank you for the opportunity to explain the important role of the energy sector in this country to the Canadian steel producers.
Well, thanks, Ms. Cobden. If I can continue on that, if you could envision an economy where we were doing less drilling for oil and gas than we are currently, or that we were last year, how much employment would that take out of your industry?
So I think it's, first of all, let's not talk about drilling levels of today because it's a very, very deep and difficult circumstance. But the Canadian steel producers, there's a good number of them that rely very heavily on the energy sector's prosperity. So their strength is our strength. It's like all of our markets. The better they do, the better off we are. And most important aspect of that as well is their commitment to using Canadian steel. And so that is something that we continue to, a message we continue to put out there, that the Canadian steel producers are a great partner for all of these customers. We're in it with them for the very long game. and we hope to see them come back to a very healthy position very soon.
Oh, thank you, and appreciate that very much. And so do so many of my friends here in Western Canada. You mentioned about the trade mechanisms that are happening with our trading partners like the United States through USMCA, and the carbon leakage that will happen because of the carbon tax, and how many jobs that's going to bleed off from your industry because of the mispricing of Canadian steel versus American steel, which is one market at this point in time. Can you explain how many jobs aren't going to come back from COVID because of that mechanism?
Well, let me first explain that CUSMA is an extremely important deal for us. So you mentioned CUSMA. I want to say it is an extremely important agreement, and we want its implementation and its full, we're looking forward to July 1st, but we want all parts of CUSMA to come into full play as soon as possible, including, as mentioned in my remarks, the rules of origin. And the carbon issue is a very interesting one. The Canadian steel producers took a leadership position on this issue just a few months ago, just before the COVID situation hit. And part of our thinking there was we want to be very good actors and help help green the supply chain for Canada's energy sector, as well as all of our other markets that I've mentioned. So you may or may not be aware that we made a collective goal. The members of the Canadian Steel Producers Association adopted a goal, we call it an aspirational goal of net zero by 2050. And we want to work with our customers, particularly our energy customers and our auto customers, et cetera.
Okay, Ms. Cobden, I just asked about the number of jobs that would drift to a different jurisdiction if we have to cost in carbon into the steel mechanism.
Yeah, so it's part of our quest on the net zero is to find solutions to reduce our carbon footprint. And so we don't anticipate and don't want to lose any jobs. That's part of the point. Yeah.
Last question, Greg.
Okay, I'll ask one more question. The last thing, Ms. Cobden, I had a few more questions for others as well, but the last question I'll give to you is, you talked about money, the Strategic Innovation Fund in particular, which has been a boon to a lot of industries and has helped them in many respects. Given the strangulation and the finances that's going to happen going forward, unless we actually find new revenue sources for the federal government, how do you see the government being able to allocate funds to what it used to support, given what it's looking at supporting going forward? And that's after $260 billion so far of COVID financing.
So I understand that choices have to be made, and and we made important choices, like I've mentioned, around the emergency wage subsidy and the important role that that's played. As it pertains to SIF, though, our view is we really need to be able to attract the right investment in this country, and our current climate is that will be very, very difficult. So we have a proven track record with SIF, where the Strategic Investment Fund, where we were able to demonstrate significant investment attraction, to 4 times the amount of level put in. So, I'm very confident that that's a good choice. I understand choices have to be made, but that is certainly one that we are behind and we hope will get recapitalized.
Okay, thank you both. We'll turn to Mr. McLeod, who will be followed by Mr. Lawrence. Michael?
Thank you, Mr. Chairman, and thank you to everyone that presented today. I wanted to ask a couple questions to the Independent Broadcasters Group. I represent the North, and I've had a lot of opportunity to talk to media in the North, and more specifically, a lot of chats with the Indigenous media in the North. I still can turn the radio on here in Northwest Territories and hear Indigenous languages spoken on a regular basis. We have 11 official languages, 9 of them are Indigenous. And I can turn on my TV and listen to people and watch them speak their language. So it's very important. It's very important to have Indigenous language shared and promoted through the use of media. I also can hear messages being passed on to people that are out in the outpost camps and trap lines and out hunting. So it's still a tradition that we use. And the last while, we've seen lots of challenges with the radio stations, especially the smaller community radio stations. We've been seeing them shut down. We had 33 radio stations, community radio stations. I think we got to a point where half of them are closed because of new technology and costs that are unaffordable. So I believe you have members in your broadcasters group that are Indigenous. And I wanted to ask, because I know there was many already very vulnerable, but this challenge, what challenges have you seen with the COVID hitting? What has it brought in terms of new challenges to the Indigenous media that they've faced in the last little while?
Thank you for the question. APTN is a full member of the Independent Broadcasting Group, but they're solely focused on television, not radio. The radio business is a very, very tough business, and COVID, if I take the example of Stingray, we're going to see a revenue decline of about 50 to 60% compared to last year. Unfortunately, I mean, we had to let go a little over 100 employees temporarily because even with the wage subsidy, maintaining operation is very, very difficult. And I understand what you're facing in the Northern Territories, because operating a transmitter, north of Yellowknife is as expensive as operating a transmitter downtown Toronto. And your audience obviously is not the same. So, I mean, to restore that level of service that you used to have, I mean, you should, my opinion is take the view of operating what we call community radio stations that can become subsidized by provincial and federal authorities. I know that
would that be your recommendation? Because my next question was going to be, how can some of these challenges be addressed by the Indigenous media?
Yeah, I mean, the nonprofit aspect of the community radio makes them open for provincial and federal subsidies to maintain operation. And I mean, I can relate a message to the folks at APTN. We can further the discussion with you, but that's one recommendation I would look at.
And if I can intervene there, Luc, one of the key funding mechanisms for Indigenous radio in the North has been what they call the Northern Aboriginal Broadcasting Program, funded by the Department of, and funding to that program has really remained static since the 90s. It's not a lot of money. It's less than 10 million in total for quite a range of Indigenous broadcasters across the North. So you can imagine, with the inflation since the 90s, the actual real dollars going to those organizations has declined over time. So I know that's a fundamental issue for Indigenous radio across the North.
Yeah, I hear that concern all the time. Thank you very much. Your microphone's not on, Mr. Chairman.
Sorry, thank you for that, Mr. McLeod. Mr. Lawrence will be followed by Ms. Kotrakis. Go ahead, Philip.
Thank you. My first question is for Mr. Buick, and would just like to ask him, I guess, a harsh question, but one that I think is raised far too often, is what would happen to Alberta if the oil and gas industry was stopped today?
Well, like I said, Alberta has diversified a great deal since the 80s. I think in large part due to lower taxes and lower regulations, but also spin-offs from the wealth created by that oil sector. So we are in a place where, I mean, we wouldn't, we have other things we do, of course, but it would be a pretty drastic effect, just like it would be in any province if you have 25% of your economy surrounding a certain industry and that disappeared tomorrow. So it would be a pretty dire recovery for a decade at least, and but Albertans are resourceful and hardworking, and I'm sure we'd find a way to struggle back. But looking at it the other way, it would be a real lost opportunity for Canada to continue to profit and have spin-off jobs coming from an industry that provides a product that the world is going to be wanting in copious amounts for another 3 decades at least.
For sure. Thank you, Mr. Buick. And to Ms. Cobden there, what would be the impact of your industry if Alberta's oil and gas industry ended today?
Yeah, again, just to reiterate, Alberta's energy sector is a very important market for Canadian Steel. So continuing for it to be prosperous is certainly a very important objective of ours. We think of our marketplace and as, kind of in thirds. The auto sector is a third, the construction infrastructure sector is a third, and the energy sector is a full third of our marketplace. So it would be very significant, clearly.
Okay, thank you. Then to Mr. Sands, what would happen if Alberta's oil and gas stopped, and what would be the impact on the grocery stores in Alberta and really across our country?
Well, it would just significantly increase prices. I mean, the cost of transporting goods is a significant one in terms of the bottom line. So it would have a huge impact on our industry, particularly because for many products they're seasonal and there's imports. So,
thank you. And Mr. Carlos, do your organizations and I have to say Banff is amongst the most beautiful places in the world. Do your organizations receive any money from the government and from the federal or from the government? And if that money disappeared tomorrow, what would be the impact on the parks?
Yeah, so clearly there's being a federal national park, there's money flows into the park to support that, the infrastructure there, the Parks Canada infrastructure. But really, the result of that is the economic activity. That $3 billion, 250 million provincial taxes and 470 federal taxes. And I think it's important to note as well that about 40% of the business in that region producing that $3 billion comes from Alberta, comes from the wealth and success of the province.
Thank you very much for that. And then our friends with respect to the Theatre Alliance and the stage employees. And I have to say, I absolutely love live theatre, and thank you for all you do. And to what extent do you receive any subsidies from the federal government or from the province of Alberta? And what impact would that be if those were taken away tomorrow?
Perhaps I'll join in, and then Arden, feel free. The federal and most provincial governments, or all provincial governments, have some funding formula for most arts organizations. The Canada Council for the Arts, and there's the similar provincial agencies. In addition to that, industries themselves will make direct contributions to specific art festivals, theatrical events, that sort of thing. I'm not aware. I'm sure there is significant contribution from the industry in Alberta, but I'm just not aware of that information.
Okay, we will have to move on to Ms. Koutrakis. Annie?
Thank you, Mr. Chair, and thank you to all our witnesses this afternoon. My question is to Mr. Buick. Mr. Buick, thank you for your presentation and for highlighting the contribution made by Albertans since 2000 by way of equalization payments, and for which all Canadians are thankful for. We all know that Albertans are going through an exceptionally difficult time, and our government is working hard to find solutions and to provide the help that is required during this difficult time, not only to Albertans, but to all Canadians from coast to coast to coast. I'm curious to get your thoughts on whether you agree with the current equalization formula, which was implemented by the Harper government and in which Jason Kenney was a senior minister. And just to remind everyone, both of whom were MPs from Alberta. So I'm curious to get your thoughts on that, please.
Sure. Just 2 days ago, Fairness Alberta released an analysis that had 8 ways to reform equalization. And I encourage everybody to have a look at fairnessalberta.ca. There's always economists and think tanks that often put out one or two flaws in the program, but we've, I think, put together a very comprehensive list that in 3 pages kind of gives you a really good primer on the key elements in the equalization program that are problematic for some people, including the recipient provinces. And so, no, we definitely think there's some significant reforms that could be made within the program. Some of them would benefit Alberta, actually. The first 4 would have some impact on Alberta, and the other 4 wouldn't, so long as Alberta is not a recipient province, but would still be ways to make the program more fair and generate more support for the concept that is in the Constitution across Canada.
Would you be able to, just for the interest of time, maybe just walk us over, we don't all have time to go on to the site right now. Just maybe elaborate on one.
The first problem I touched on a little bit in my comments, and it's that the health transfer and the social transfers have a $75 billion federal program that goes to provinces to cover provincial services. Because Albertans pay a higher proportion of income tax, we end up actually subsidizing that program $3 billion. Now that's $3 billion that goes from Alberta taxpayers through the federal government to then other provincial governments to cover what is a provincial jurisdiction. So there's a duplication of equalization because there's also an equalization program that's meant to redistribute funds to provinces to ensure they can provide good services. So we'd like to remove that duplication. We also think that the unchecked growth on the program, $20 billion now, and it grows with GDP regardless of how close provinces are getting. So the other big point is that despite the fact that fiscal capacity is shrinking pretty significantly over the last few years, particularly due to the energy downturn, the equalization program keeps growing. And so in theory, we could all be within 1% of each other, but the 1% that's on the lower half would get a full $20 billion. And then one last thing to think about is that it focuses on equalizing the fiscal capacity of provinces to pay for their services, but it doesn't think about what it costs to deliver those services. So we're trying to find a way to make sure everybody can deliver relatively equal services. It doesn't make any sense to ignore that it might only cost 85% as much to run a hospital or to run a service in a certain province compared to, say, Alberta or Toronto or Vancouver. So we really need to think about making sure that we reflect the cost to deliver those services.
Last question, Annie.
Sure, and this is to Mr. Sands. During the COVID-19 crisis, many Canadians have begun to increasingly rely on e-commerce platforms to meet their needs, including buying groceries online. I expect that grocery delivery will be a highly valuable service for many Canadians, even in remote areas specifically, once the COVID crisis ends, and specifically for those who may have limited mobility. Do you see an opportunity here for the independent grocers to maybe offer some delivery services or some kind of other service that may be a market niche?
Yeah, for sure. And independents are already doing that. But I should stress that the niche that the independents already have, because again, they're up against the chains, the Loblaws, the Walmarts, the Sobeys, and they have to. Their niche is to differentiate, and that's what I was talking about earlier. They hire local, support local, buy local. That's really their niche. It is an interesting question you bring up, and I'm sensitive to the time because I'd love to talk about that more to the committee at some time, because that growth of the e-commerce and who operate in can operate everywhere and at all hours, and you have to juxtapose that against the realities of the businesses, not just independent grocers, but other businesses in your riding, which, the bricks and mortar, and they're paying fees, premiums. They have to, adhere to bylaws and a myriad of other regulatory and financial challenges that the e-commerce giants, mostly from outside of the country, don't have to deal with. So it's an interesting question. But to circle back to your question, yes, that is something we're adapting to, and it's like the migration away from cash. But there is still a need for independent grocers to have that strong bricks and mortar presence in communities across this country.
Okay, thank you both. I don't think there's a session that we haven't heard something about the e-commerce giants from outside the country. Before I go to Mr. St. Marie, Ms. Cobden, I've got a question for you and Canadian steel producers. Looking ahead at recovery, how prepared are your clients? As the Canadian steel producers' clients, how prepared are they to invest in Canadian facilities for long-term viability? And how important? What's it necessary for the Canadian government to do to ensure that investment becomes part of a recovery strategy?
Yeah. So. Thank you for the question. Indeed, attracting the investment needed to make to make those investments, to make that happen is tricky. Today was tricky yesterday and will likely be tricky tomorrow. It's why we feel very strongly that there's a big opportunity for us to attract that investment if we work together to stimulate it. So that's where our recommendation around recapitalization of the Strategic Innovation Fund comes from. It has been a very successful fund. I know there's a lot of good, strong competition for that, by the way, but the steel industry, we are happy to compete for that support, but it does bring investments to our industry and to our markets, and it's extremely important. Beyond that, there are things too that can happen that can actually stimulate our individual marketplace. So we've got different ideas on that too that are not related to steel itself, but to large consumers of steel.
Okay, thank you for that. I guess one other part of that is, where does the international clients that you have, if the federal government is not there for the steel industry, what happens with our international clients that you would have?
Yeah, so I think that, again, this comes back to how do we attract the investment here? And there's no question that our industry is competing with their international colleagues all over the world for that investment. So anything that can be done that brings Canada to the forefront of bringing these dollars to our industry for that, recapitalization of our sector is critically important to us. If that doesn't happen, the investments won't come, and we will not continue our quest to be the most competitive and the most productive. So it's linked.
Okay, thank you. That we'll go to one question from Mr. St. Marie and one question from Mr. Julian, and we'll let her wrap it up. Mr. St. Marie.
Thank you, Wayne. My question is for Madame Saint-Onge and Madame Préjean. To date, people have said that they're quite satisfied with the extension, the 8 weeks extension for the CERB, but it's particularly important for the arts and culture sector, as you have said. It is important that support measures have to exist and even be extended. The independent media, the regional media feel that very much. Madame Saint-Onge, what should the government do? First of all, the government can do many things to help the media and the arts and culture sector. First of all, it could think about a program where it could support independent workers, those who are self-employed. But there could be a new program that could be set up that when the 8 additional weeks of CERB run out, it would kick in. This new program could kick in, and there would be no hole, if you like, for the people who receive it in the arts and culture sector. I would ask all of you to think about that. It's very important. Bear it in mind. Also, with a specific question on the media, there are things the government can do. When the tax credit, the payroll tax credit was set up, there were recommendations from an expert panel to increase the eligibility level to 35% rather than 25%. And in this present crisis, I think that it could even be extended to newsrooms, to audiovisual businesses. It would be valuable, it would be valid for the arts and cultures, but I think that Canada no longer enjoys the luxury of depriving itself from the income that it could derive from taxing the web giants and their digital platform ads. Digitalization should be an opportunity for us. These people are creating so much space and taking it up in our cultural environment that I believe that the government should come up with something to compensate for that. Well, that's very clear. Madame Préjean, do you have anything to say? No. I think Pascal really did it well. Thank you.
Thank you for that. Mr. Julian, we'll have to wrap it up after you.
Thanks very much, Mr. Chair. Thank you to all our witnesses. It's been a very interesting discussion. My final question is to you, Ms. Cobden. Brian Massey, our industry critic, and MPs like Scott Duval, Matthew Green have been talking about the importance of having the steel industry involved in an overall industrial strategy. In Canada, we haven't done a very good job compared to other countries. How important is it for Canada to finally develop an industrial strategy with one of the key components being steel producers in the steel industry?
Thanks for that question. Indeed, I think that it's one of the lessons we need to take forward from this pandemic, that we've lived through a horrible circumstance here. But one of the bright spots in it is the understanding of the importance of manufacturing in the Canadian economy, the role that it can play to have the capabilities in our own country to make and create necessary and essential goods. So that was, I think that is a really important aspect. Steel producers are the largest manufacturers. We're a significant footprint in that regard. So a strategy that really takes shape and understands the aspects of how do we continue to grow our business and be successful is obviously something we would support.
Okay, thank you. Just a couple of points. Mr. Buick, could you, Mr. Buick there? I don't know if he's listening. Mr. Buick, could you send us those 8 points you mentioned on equalization? And Mr. Carlos, you had mentioned 4 points to assist parks. I know you didn't get much elaboration on it. If you could send those to the clerk as well, they will be in the record, but send them to the clerk and we'll pass them on to finance. And for triodectric, you had no questions, but we just met prior to this panel with bank economists, and they certainly said one of the areas that health is key to the recovery, dealing with the health side of this. Have you approached anyone, or has anyone approached you on what you indicated that your company can do in terms of quickly setting up medical facilities and those kind of things? I think you have a very, very interesting proposal that would certainly apply to Mr. McLeod's territory up north where there's problems with permafrost and everything. But have you been approached on the health side for what your company can do?
Actually, we have. It's been happening since this pandemic was announced in March, and paperwork has been in the work. Designs have been in the works. They've just come across our table just now, the last week, actually finalized. And we're working with actually a manufacturer, steel frame manufacturer in Ottawa, to create these quick deployable foundation rooms and hospitals or buildings that our foundation can go on to. So you have a steel structure and a steel foundation that will be able to go basically anywhere in Canada. It will be containerized, and it could be used by, again, any provincial government, any ministry, any municipal authority that needs support and help in terms of quarantining people. Let's say we have the workers coming in to pick our fruits and vegetables. We need to have a secure place for them. So that will be available as a facility. If you need to do some triage up north, especially in the Arctic regions, this can be deployed either by a barge or it can be sent up by a Hercules airplane in the back of Hercules, because it's all containerized. So we are working very diligently, and it's coming to fruition as we speak. I can't say anything else. There are certain legalities that I cannot divulge right now, but it's in the works, and we're thankful for the support from the Canadian government in this project, and by the committee that I think you're aware of what's going to be happening pretty soon.
Okay, thank you all for your presentations. I know this was a fairly mixed, wide-ranging panel that's covered a lot of bases, but I think it shows how complicated things are in this pandemic time. So I want to, on behalf of the committee, thank everyone for their presentations, for taking our questions, and also for the constructive criticism that was laid out. We appreciate it from all angles. So with that, thank you again, and meeting adjourned.
Thank you. Thank you. Bye-bye.